Hello everyone, Radhe Radhe. So in today's lecture, I'm going to revise all the concepts of the Advanced Capital Budgeting Decisions chapter for you in detail. We covered this chapter in our regular batch in a total of 4 parts, covering around 12 topics. And this chapter, like the others, was a completely normal chapter. There was nothing particularly special in this chapter. You could call it a very normal, easy chapter. Because you might find a few more questions in this chapter, but they are very easy indeed, just as I have told you, and we have practiced them as well. You can solve the questions in this chapter very easily after listening to the lecture, or even just by reading and memorizing the notes once. The questions are of that level. Most of these questions are repetitive, means if a topic has 4 or 5 questions and you solve even one correctly, then rest can be solved automatically. So it's actually a very easy chapter. You won't face any difficulties. Let's quickly start revising its concepts. Look, what does this chapter teach you? You'll know from its name, it teaches you to make capital budgeting decisions. How will we make capital budgeting decisions? The term capital budgeting decision, as soon as it comes to your mind, probably sounds familiar. So absolutely, you have already studied capital budgeting at the intermediate level. So is it the same thing here? No, it's not. At the intermediate level, you studied one part of capital budgeting, which is a very vast topic, and a part of it was taught at the intermediate level. The institute taught you that part there. Now the story beyond that, the subsequent part is given here at your final level. It's named as Advanced Capital Budgeting Decisions. Here we will discuss advanced capital budgeting, the part that comes after. So if we are discussing advanced topics, then this must be a tough chapter, because many students never fully understood capital budgeting at the intermediate level. That itself seemed tough, and this is the advanced part. So how will we understand it? It's only advanced by name, otherwise it's nothing much compared to intermediate capital budgeting. For a moment, I will assume that intermediate capital budgeting was tough for you all. But despite that, this chapter is very easy. It's only called advanced, even though under the advanced label, you only need to learn very small things. It's actually a very easy chapter, so you should never skip it. In a way, it gives you free marks. So without any further delay, let's start the first part, Introduction to Capital Budgeting. As I said, this advanced part of capital budgeting is in your final syllabus. But to understand the advanced part, to know the concepts that follow, you first need to know the basic part. What is capital budgeting? Students, first of all, you need to understand capital budgeting basics to move forward, as they're essential here. Exactly as what was taught and what you learnt in intermediate. I couldn't get it then, so how will I understand now? So the basic part of capital budgeting from the intermediate level, which I had covered, that's what I am going to revise for you now. It's not that the entire intermediate part is applicable here. Not at all. It's a very limited part. So you know the basic part of capital budgeting is what's applicable here. Here I will explain all the assumptions there are for this level. Don't create ifs and buts like in intermediate it was like this, or our teacher taught it differently, or we used to include these. Let's avoid that. Here at final level, I'm telling you what's going to be useful. This basic part isn't even part of the syllabus or module. I have prepared this just for you. Otherwise, I could have directly started the chapter from the advanced part, which is part of your syllabus. And this teaching ensures that the chapter feels very easy. You cannot progress without this. It's useful in questions, so pay attention. Let's see the basic part. First of all, if we talk about capital budgeting, it's a process of evaluating and selecting long-term investments or projects. It's a process to evaluate or select long-term investments or projects. For example, let's say that this machine costs 1 lakh rupees. Okay, so I have to make a decision that should I go and buy this machine from the market for 1 lakh rupees or should I not? If it's available in market for 1 lakh rupees, then should I buy it or not? That's the decision I need to make. Or suppose I feel like setting up a factory in this area. If I set up that factory, I will produce goods. My business will run. So should I undertake this project or not? I have to make this decision. These are called long-term investments or projects. So decision making for these is what you call a capital budgeting decision. Then how will you make the decision? It's very easy. Look for this machine of mine. To bring it, to buy it, an investment of rupees 1 lakh will be required. So does it deserve a rupees 1 lakh investment? Is this rupees 1 lakh investment worth it? How will you judge that? Just see how much benefit you will get from it. So why do I spend money on something? Because I feel I will get some benefit or some return from it. If I spend 1 lakh on this, I need to check what return I will get in exchange. If the return is more than the investment, then you should do it. And if not, then don't. That's it. Okay, this is your entire capital budgeting. So for capital budgeting decisions, some techniques are used which you studied in Inter, as I mentioned. We'll discuss only 5 techniques, though not in the syllabus. They're essential for chapter progress, and I'm telling you this upfront. So in Inter, you might have studied many techniques. Here I will only tell you the part that's useful in your syllabus, in exam, in questions, because we need to focus on what's relevant for exams. You need to look at 5 techniques for capital budgeting decisions. Among these, the first technique is the net present value or NPV method. And as soon as you hear the name, your whole heart and mind must have understood what it is. You know it very well and you have used it a lot. We're going to learn this same technique here, and I'll quickly explain what it is. Before that, let me tell you one more thing in all your questions. When I said that you will do advanced capital budgeting, let me tell you that in all the advanced capital budgeting questions, you will first have to calculate NPV. First, you will calculate NPV. Then you can move on to advanced aspects, which is generally assumed for all questions. In 99% of questions, the NPV method will be used. I am going to tell you 5 techniques. And the institute rarely asks about the other remaining techniques, but we will still cover them as needed. But in 99% of questions, the institute uses only the NPV method, the most important one. So you have to carefully understand how you will do what, and it's easy. Look, what is NPV? You know, as I've told you, NPV is the net present value you will get from a project today. Essentially, it represents the overall net benefit. I'll quickly explain this with the example I gave you in the lecture. For instance, I'm making an initial investment of 1 lakh in this machine, which can also be considered as a project as these terms are interchangeable. So I'm investing 1 lakh in this. And now I need to see what all the benefits I will get in return. So I analyzed and found that if I invest in this, I will get cash inflows of 30,000 every year for 5 years. Alright students, your project or your machine, like anything else, has a particular useful life. After its useful life is over, a machine or the project ends. For example, after 5 years, this machine will become scrap and useless. So I will use this machine for 5 years, produce goods or whatever work I do. From that, I will get a cash inflow of rupees 30,000 every year for 5 years. So you understand the total benefit? You'll say, yes sir, it's very easy. 30,000 into 5 benefit of 1,50,000 is visible. And how much is the investment, sir? It's 1 lakh rupees, which means we can see a net benefit of 50,000. So we should invest. Look, we've calculated the net benefit, which we call net value, but you can't call this NPV. This is not a correct way to make an investment decision directly like this, because you missed out on one thing. And what is it that you missed? That you are investing 1 lakh today, but the cash inflow you will get after investing in this machine will be at the end of each year. 30,000, 30,000, 30,000 at the end of each year. So the cash flows that you're going to get will be received in the future. The investment is today, the timeline is different. You cannot compare them. In decision making, we understand that only cash flows of the same time period can be compared. Okay, so you should do one thing, that is find out the present value, that is PV of all future cash flows as of today. Meaning calculate the PV of future cash inflows and then compare it with the initial investment. The difference you get will be called NPV. The difference that you then get is called NPV. This is NPV. You've been learning this since intermediate. I've just given you a brief overview. Now, I'll explain this step by step. You'll do the calculation in 4 total steps, and it's a very easy calculation. The very first step is to find out how much your initial investment in the project will be. Initial investment is the initial cash outflow for the project incurred at time 0. So what did you spend? Yes, what was your investment at time 0? The assets cost, the assets amount, purchase cost plus installation cost. For example, suppose I bought the asset for 90,000. Its installation was special, needing 10,000 to be done by someone else, making the total expense 1 lakh, and you will take the entire amount. You have to take this. Plus, if you have to invest some money in working capital at time 0 for your project, then you have to take that as well. Investment of working capital. What is this? Let me explain to you the investment in working capital. Look, there are 2 types of initial investment in a project. Initial project investments involve asset cost and working capital. Since you know asset cost, what about working capital investment? Look, when you set up a project, for example, suppose that I want to set up my factory. In the project inside my factory, there will be some expenses on assets and so on, and that is my initial investment. But will I be able to start my business simply by spending on assets and generate cash inflows each year? No, because I haven't invested in working capital. You see, if I set up a factory, I'll have to produce and keep goods ready, right? My business, suppose, is such that I have to produce goods first and keep them. I have to maintain inventory. Only then will I sell that inventory, and then I will get cash inflow. Understood the point? Inventory is a current asset, and you know working capital is current assets minus liabilities. Similarly, I'll have to maintain inventory. If I buy raw materials, my creditors might increase. Similarly, let's say that I have kept an amount of 8 or 10,000 as cash bank balance spare in my business, which can be used anytime when needed. So that is a current business asset. Understood the working capital amount? If you want to start a business or project and get cash inflow from it, then initially you also have to invest money in working capital in the business. So in business, you'll have to invest money in assets and also in working capital. The initial project investment has 2 components. Total them up and you will get step 1. It's easy. Now let me tell you a secret. The point about investment in working capital will generally not be found in any question of this chapter. So don't worry about it. Then sir, why did you write it? Because there's another small chapter related to this which only has questions on this and nothing else. This point appears in 1 or 2 questions, so we will refer to it there. This point is generally not useful within the questions of this chapter. Next is step 2. I found out how much investment I need to make in my project at time 0. In the second step, now find out what cash inflows you will get from the project. What cash inflows are you going to get from the project in the future? What cash inflows from the projects? So you need to find out the cash inflows at each year and during the life of the project. Your project will have a particular life, like in our example, the machine has a life of 5 years. In these 5 years, find out what cash inflows you are going to get from the project at the end of each year. I've written it here, it's very easy. The calculation in front is very easy. Let me tell you something, I have already taught you about this in the business valuation chapter, the method I taught for calculating the firm's cash flows FCFF. It's exactly same. Sir, then what's the difference between this chapter and that? I will also explain the difference. Many people misinterpret them and think they are the same. The calculations and all are similar, but both chapters serve different purposes in their own place. I'll tell you a bit about that too, which I also explained in the regular batch. Take a look at this example. How do you get cash inflows at each year end? It's very easy to calculate. Just take sales and subtract all expenses including depreciation. You'll get EBIT, earnings before interest and tax. It's an earning with all expenses except interest and all tax are deducted. Sir, what to do now? Deduct tax from this. Why isn't interest deducted? Interest is not deducted because it's the project's cash inflow. This reason matches business valuation for FCFF. No detailed reason here. It's a revision video and I have already explained it in business valuation. So no reason will be discussed again here. Still to briefly tell you, look at this machine. The cash inflows this machine generates have nothing to do with where the rupees 1 lakh I invested in this machine came from. Did I bring that rupees 1 lakh from my home savings, or did I bring it by robbing someone, or did I bring it on loan from someone? Whether I brought 1 lakh from my savings and bought the machine, it will still give the same cash inflows. Or if I had brought that rupees 1 lakh by robbery, this machine would still give the same cash inflow. If I had brought that 1 lakh rupees on loan, this machine would still yield the same cash inflows. Interest won't be deducted, as I've detailed in regular batch or business valuation. Understood the point? So interest will never be deducted. That's why we called it the project's cash flow. In business valuation, we called them the firm's cash flows. I'll explain the difference. When you directly deduct tax from EBIT, you obtain NOPAT. I've used NOPAT directly because I have already explained what it is, and we're continuing from business valuation. Look, this chapter has linkages with all the other chapters that have already been taught. But some students are over smart and they think they know more than the teacher. So if you try to do this chapter before others, you won't be able to. Many chapters are linked to this. I have already taught many concepts in different chapters. So you got no pet. Now what you have to do in this? You need to calculate cash inflows. When you calculated above, you deducted all expenses, so you must have deducted depreciation as well. Since depreciation is also deducted, add it back because it's non-cash. Similarly, recall that other NOPAT adjustment from business valuation when calculating cash flows, that plus minus working capital changes. If working capital is decreasing every year, add it, and if it's increasing, deduct it. The logic was explained thoroughly with ample time in business valuation. Check there and don't discuss here. If I tell you briefly for recall purposes, working capital involves investment. For example, 50,000 was initially invested in working capital. In the next year, the company actually invested another 1,000 and those funds went into the business, right? So it's a cash outflow, money went out. Second year saw another 2,000 investment and cash outflow. Minus because working capital increases, right? Can you tell me what does decrease means? For example, if working capital was 50,000 and you withdrew 2,000 from the business, which means it is reduced, ultimately generating an inflow. Add for decrease, deduct for increase. Logic, business valuation or regular lecture. So you will get the cash flow. Now you've repeatedly said this is the FCFF from business valuation. So there was one more thing. So in business valuation, plus or minus capex was also there, but it's not applied here yet. So now I'll tell you the differentiation between that chapter and this one. It's a very small difference that those who study conceptually understand. In business valuation, our purpose was completely different. We focused on company valuation. We valued companies for the purpose of acquiring them. So we used to find out the value of the entire company. There we talked about the firm's value. Here we are talking about a project, machine and all. When I'm talking about this machine, now tell me what plus or minus capex is there when I'm talking about investing in this machine. I've already invested in the machine and no more annual machine investments to be made. There's nothing about capex in this. But when I talked about a company or a firm, then in a company, there can be capex expenses every year, right? That was included in FCFF, but it won't be here, and I've explained the reason. Working capital adjustments won't appear in this chapter since working capital is not involved, and we will cover that in the other linked chapter. You must have understood how the cash inflow for each year is taken. Now look, you will calculate the cash inflows from the project for each year end, so you will get them during the life of the project. We assume that cash flows occur at the end of each year. Many overthink and doubts arise, which I covered extensively in the regular batch. I'll briefly explain it. Cash flow is not like you'll get 30,000 at the year end every year. But sales happen every day, so cash flow should come every day. Absolutely, that's how it is. But will you calculate the PV of daily cash flows? Imagine how difficult the calculation would become for anyone. In practical life, you can still do this with Excel. For exam purposes, the institute simplifies stating cash flows at each year end. The first year's cash flow occurs at year end, similarly for second year. This is how the working generally proceeds, which is a normal assumption. This has been taught to you since childhood for exam purposes. Still, some people don't understand. If you need to calculate cash inflows from the project, so keep in mind for the NPV method in the capital budgeting part, you've got the cash flows during the life. And you get an additional cash inflow at the end of the last year when calculating cash inflows. Meaning, when the project's life ends, your asset's life ends, in that year at the end, you get one last additional cash flow. What is that? Release of working capital invested till date in the project. Whatever working capital you had invested in the project till now, you release all of it in the last year. You take it all out and you get a positive cash inflow. Look, what is this? Suppose I initially invested 50,000 in working capital. In the first year, I invested 1,000, which increased outflow, then 2,000 and another 1,000. In fourth year, 1,000 working capital withdrawn, then added this decrease. Now, at the fifth year end, how much working capital is invested in the business? It was 50 initially, then 1, 2 and 1 more were invested, making it 54. With 1,000 withdrawn from 54, 53,000 remains invested. At the end of the fifth year, all working capital invested in the project will be released, generating an additional cash flow. You must remember all of this. Okay, as I mentioned, working capital isn't typically in this chapter, but you must remember it for capital budgeting questions. Also in the final year, you'll receive the asset salvage value. Since its useful life will be over, you can then sell it as scrap and realize whatever money you get from that. Salvage value. And when you get the salvage value of the asset, there will also be a tax effect on it. So in the last year, when you sell the asset, you will get the salvage value. If you get salvage value, it also brings a tax effect, and when you sell, it's capital gain. So do we have to study income tax? No. Don't go into income tax. If you apply actual income tax, you won't get any marks. I'll teach you how to calculate the tax effect here. It's very easy to calculate the tax effect. You are selling, so tell me at what price you are selling and the book value or carrying amount at the end of the last year. Instead of sales minus cost of acquisition in case of capital gain, it is sales minus book value or carrying amount in the books on that day. Normal calculation. Don't apply only income tax. We'll apply a bit of income tax and a bit of FM. You sold it for 5,000 and then you need to check what its carrying amount was in the books at the end of the last year. Suppose, for instance, it was 3,000. 3,000 assets sold for 5,000, so that's a 2,000 capital gain. Should this 2,000 capital gain be taken as cash inflow? No, don't take it. The 5,000 already covers everything. Don't take this separately. This was calculated only for the tax effect. On our 2,000, suppose the tax is 30%, meaning I will have to pay a tax of 600. The 600 tax amount is an outflow and must be deducted. You can see that the tax effect is shown as plus minus. Working capital release and salvage value are inflows, and if the tax effect causes tax payable, then you should deduct it. And there can also be tax saving. Let me give you an example. The salvage value was 5,000, but the book value was 6,000. So worth 6,000 was sold for 5,000 with a capital loss of 1,000. Capital loss means tax saving. Why tax saving? Because this capital loss will be set off in the business and our tax will be saved. Calculating at 30%, it will be 300. A tax saving of 300 happened. Tax saving of 300. So tax saving is a definite benefit, which means inflow, right? So it's an inflow because your tax will be saved. If it's inflow, then plus. So never memorize plus minus. Some people keep memorizing plus minus for all these formats. Don't memorize plus minus. Logically consider if it's inflow or outflow, as everything hinges on that. This, including basic math practice, was already covered many times in the regular batch. Redoing it here takes too much time. These are the basic things. Those who have taken the class, you know how to practice. Practice maths if you are weak. These are very basic things. Understood? Now take these final year cash flows. In business valuation, when we talked about firm cash flows, there were no special cash flows. And why? Because when we value a company, we don't think that it has a useful life of 5 years or something. We value companies as going concerns, assuming continuous operation. Remember, there was a concept that this cash flow will grow at this rate for 3 years and then perpetually or indefinitely continue like that. There was never a concept of last year, so no working capital was released, nor was there anything like salvage value of an asset. Always keep this in mind for capital budgeting questions. Suppose a business valuation question comes, don't release working capital in it. You might think of memorizing and performing accordingly. Some people will say that, sir, didn't get it done there. So I've explained the concept even in the revision video, because your purpose there was entirely different. A company running long term is considered a going concern, so working capital is never released. Do it here. How will you know in the exam which topic the question is from? You are doing a great disservice if you can't identify whose question it is. It can be identified very easily. If you've studied well, you can easily tell the question's chapter and topic. If you can't even identify that, then understand that there is some major flaw in your preparation. Now, move forward. Write 2 notes in step 2. I've already explained the second note. To calculate tax effect on asset sales, subtract its book value from salvage value, then multiply by the tax rate. If this comes out positive, remember it means you've directly incurred capital gain tax, and that's an outflow. If negative, understand it's tax saving from capital loss and a cash inflow. Regarding note 1, allocated fixed cost, apportioned overheads and historical cost are not included in cash flow calculations. Whenever you will calculate cash flows, you must ignore and should not consider any existing overheads apportioned or allocated to this project by the company in the accounts. For example, one project was already running and I invested money in this new machine or project. So the company's accountant for an existing project, let's say, had a 20,000 annual fixed cost. They said, now that we are starting a new project, let's do one thing in accounts. Out of this 20,000, let's allocate 5,000 of the fixed cost to this new project in accounting. Let's show it in the books of this project. Is this 5,000 cost the cost of this project? No. If this project wasn't undertaken, it would still have been incurred as it's the cost of the old project. What does this project, this machine, have to do with what you are doing in accounting? So, never include such allocated fixed costs or apportioned existing overheads in the calculation of cash flows. Ignore them. Suppose historical costs are given. For instance, I went to set up a factory, a project. For that factory, I first sent a research team to test and see if it's even feasible to set up a factory in that area, and if we set it up, will we get any benefit? I conducted such research. Suppose it cost 10,000. After that, I invested in the factory. Now you may ask, sir, that 10,000 cost I incurred before investing in the factory, should I count it as an expense? Do not count it at all, because it's a historical cost. Things like the cash flows and all that will be received after investing in the factory would have been the same before and will be the same now. It has nothing to do with whether I conducted research testing. I did that for my own satisfaction. The factory or the project didn't ask us to incur research cost on them. Suppose my neighbor also set up a factory there but without research. So he will also get the same cash flows. Understood the point? So it has no role there at all. The historical sunk costs are of no use. What's past is past. It has already gone. You need to focus on your future because your present and the future ahead are fully in your control. The past is not, so it's essential to overcome any past crying, sorrow and grief. You should never drown in the past. I told you a whole thing about this in the regular lecture, how people remain lost in the memories of their ex. You remain lost in the memories of your attempts. So many attempts I've had, this happened, that happened. Nothing is going to happen. You can't change your past. You cannot go into the past and correct it. Every human makes mistakes. I also make them. We have made them. Everyone has. A human makes mistakes. That's why he is here in this world, on this earth. Otherwise, who knows where he would be, alright? We are on this earth because we all make mistakes and you cannot go back to correct the past. But your present and future are now in your hands, which you truly can rectify. Now you can work hard properly. Now you can plan out your things for the future. What can be done next? The past, including historical and sunk costs, should never be considered. Remember this. Now for step 3, calculate the project cash inflows PV. That's simple. You found out the initial investment and what cash inflows will be received in the future. You have to PV the future cash inflows using a discount rate. What's the discount rate? First, it's given in the question. If not, then the project's required return, also given in the question, is second priority. If project's required return is not given, then third priority is cost of capital WACC. Now, why this priority? Is it just arbitrary or is there logic behind it? I've been teaching you this since the basics of AFM. Still, I'll quickly tell you again. Look, your required rate of return is your discounting rate, and understand why that is. I will get a cash inflow of 30,000 every year as I took in my example for 5 years. This 30,000 needs discounting to present value with my 10% required return. What do we need to understand now? I'll get cash flows of 30,000 from this project or machine for 5 years. Now I have decided how much required return I need from this machine. I need a 10% return. Regarding future cash flows, I explained during the PV discussion in basics. Try to understand. Future cash flows already include the return and interest. So if you require a 10% return, it's simply part of that cash flow. So if you want to remove that, what do? PV the future cash flow at 10%. Then you will find out the principal amount in a way after removing the return, meaning how much amount you should invest, its fair value. So if I PV the 30,000 cash flow that I will get every year at 10%, that value will be approx 1,13,700. Do you know the meaning of this value? Those who understood PV, I have explained it in so much detail from the beginning, and I had already given a lecture in the regular batch and told you that I am giving a final crux of PV for the last time. But I won't tell that here, just listen to me. What does 1,13,700 mean? That's fair value. So what is the fair value of this machine for you? This machine will generate 30,000 cash inflow for 5 years. I need a 10% return, so if I remove the 10% return from the future cash flow, that amount becomes 1,13,700. That means if I invest 1,13,700 in this machine today, I will get a 10% return every year. You can verify it if you want. Ultimately, that's what's happening. So if I invest this much amount, I will get a 10% return. Meaning if the machine is available in the market at this rate or cheaper, I should buy it. And if it's more expensive, I shouldn't buy it because then I won't be able to get a 10% return. Do you know what this is exactly like? It's the same thing you've already done in security valuation, in share or bond valuation. There's nothing new in this chapter. In the FM subject, the basic fundamentals are the same. As mentioned, linkages will recur and you've done this. You PV'd the future cash flow at a required return. Its fair value logic has been explained. Now make your decision. Machine investment is 1 lakh and NPV is 13,700. If the fair value is higher and it's available cheaper in the market, I should buy it. It's absolutely beneficial. However, capital budgeting investment decisions for projects are never made this way. One more step is added, which is our next step. Step 4, calculating NPV. Understood the point? Okay, let's see. We discussed the discount rate, then I explained required return, and WACC is the third priority. What is cost of capital? It's the minimum required return. Now just suppose I brought my money, whether from personal savings or loan, like debt and equity, then invested 1 lakh in this machine. I also have to repay the dues from cash inflows coming from this machine. The cost incurred on them, suppose that cost is my 8% WACC. You must earn at least this return, right? Because this is the minimum required rate. If the discount or required return isn't given, WACC is then the required return, as that's the money we need back. Understood the point? That's it. Final step. Calculate the project's NPV. This is PV of cash inflows minus initial investment from step 1. Essentially step 3 minus step 1. So we had a PV of cash inflow of 113,700. How much to invest? 1 lakh. So an NPV of 13,700. If NPV is positive, accept the project. If negative, reject it. You have learned this, but now I'll give some extra knowledge for your understanding. You will gain more confidence in this chapter, which I already told you. This 13,700. Do you know what some people think it is? Some people believe that 13,700. And when I say some people, I really mean that a significant 95% of individuals actually consider this 13,700 figure to be simply the profit from the project. So this kind of thinking is completely utterly wrong. Whoever thinks this here, and I'm saying with a guarantee that 95% of people think this, even those who teach, let alone those who study. So people don't even know what it is. Those who have never properly understood PV and these things, they just make videos without any real understanding. You know, 13,700 represents the project's extra return. You needed a 10% required return from this project. And so, based on that 10% return, you should have invested about 113,700 rupees, as this was indeed the fair value of that machine. Meaning if you invest 113,700, you will get a 10% return. So a 10% return is being received and I'm only investing 1 lakh. That means I'm getting an extra return of 13,700 from this project. This project is giving an extra return of 13,700. This is the meaning of NPV, net present value. If NPV comes out to be 0, you still accept the project because you got the required return, didn't you? The extra return was 0. But what if NPV is negative? Then it means you didn't get the return you needed. Understood the point? So remember, your total return in this particular example is more than 10%. That total return is what you all call IRR, which students till today haven't understood what IRR is. I will explain it to you a bit again here in the revision. You will understand it very well. NPV part is explained, just remember 4 steps. Then you'll solve every exam question. Next is the Profitability Index PI method. Profitability Index PI method is not important. It appears in couple of questions. Let's quickly review it. Profitability Index is the PV of project cash inflows from step 3 divided by initial investment. In our example, it would be 1,13,700 divided by 1 lakh. Do you know what this represents? Today at time 0, in terms of present value, if I look today how much I am getting for 1 rupee of investment, what return am I getting and how much extra money is it becoming today itself? This results in 1.137. So investing 1 rupee gets you 1.137, which is profitable. This means if your PI ratio is greater than or equal to 1, accept the project. If it's less than 1, don't. If it's 0.9, then investing 1 rupee means you're getting 0.9 and no benefit. It's simple. Remember, it's for odd questions, not very useful. Don't spend too much time on this. Now let's look at internal rate of return, IRR. The third technique is internal rate of return, IRR method. This is also not very useful in exam. It might have a slight link in a couple of questions for reference. Otherwise, it's not very useful. You won't be asked to calculate it like that. Why am I teaching this? You see, you need to know a little for occasional questions, and I'll give you some knowledge because many people don't even know what IRR is. IRR is a rate at which if you find the present value, PV of future cash inflows, it becomes equal to the initial investment in the project. Meaning it's a rate where if I'll PV the future cash inflows, that amount becomes equal to the initial investment. So, do you know what happens at IRR? The PV of cash inflows from the project equals the initial investment. Look, at this rate, the NPV will always be 0 because if the PV of cash inflow and initial investment are equal, then by subtracting initial investment from the cash inflow PV makes the NPV 0. This means if you PV cash inflows at the IRR rate, NPV will always be 0. I've explained what's written and only exam relevant content is covered. Beyond this, it shouldn't be my purpose to explain, but still I'm telling you little for reference. It's crucial for you to know this. Many hold misconceptions. From Inter, they don't understand, there is no one to explain it. I'd still like to explain this because even though it's a revision video, this is really important. What is internal rate of return? Let's briefly examine that because many people live with a common misunderstanding. Many people think that IRR and interpolation are the same thing. They think IRR and interpolation comes to mind. I'd say there's no connection between interpolation and IRR, not even remotely. Look, interpolation is a mathematical formula and IRR is a decision-making technique in the capital budgeting. It is a method. And interpolation is a mathematical formula. It can be used anywhere. It's a mathematical formula. It's a formula. Lower rate plus its value minus required divided by lower value minus higher value, then times higher minus lower. As soon as they hear IRR, people think it's interpolation. Many people even call it interpolation. I get messages from the students from outside that what to do about the interpolation. Later it turns out they are talking about IRR. So interpolation and IRR are very different things. Interpolation is a mathematical formula that helps you calculate IRR. If I need to calculate IRR, then we use the mathematical formula of the interpolation. But IRR and interpolation are not the same thing. IRR is a decision-making technique. IRR is a technique. Let me clarify with another example. What misunderstanding are you living with? I mean, what kind of misunderstanding? What level of misunderstanding? Listen once. So if I will say here, see, how do we calculate NPV? By subtracting initial investment from PV of cash inflow. So I'd say minus means subtraction. If I will say that subtraction and NPV are the same, you will call me crazy. You are making that same mistake. Subtraction is a mathematical term. It's a mathematical technique, a mathematical formula, which can be used anywhere. So it is used to calculate the NPV. Similarly, interpolation is a mathematical formula, a mathematical technique that you use to calculate IRR. Now you have understood the IRR and interpolation difference. So what is IRR? I'll explain briefly. IRR is the total return of the project. What total return will you actually get from your project? This one. What return will you get from the project? That is IRR. And then you're saying actual total return and you mentioned a required return. You've done so many things, so there's a difference between these two. Required return from the project is what return do you want? IRR is the total return I'll get from the project and required return is what I want from the project. So there's a difference between the two. How is it so? Let me explain with a small example. Look. What are you doing here? If I talk about required return, I PV my future cash flows with the required return. So what do I get? The fair value of that asset. Like in the example above, I did PV of the future cash flows with a 10% required return. I got the fair value of 113,700, right? This machine's fair value is 113,700, meaning investing will give you a 10% return. This indicates the fair value. You've already done this exact same thing in bond valuation security. There was a topic called bond pricing. You used to PV future cash flows with a similar market interest rate, which was in a way the required return. You found the bond's fair value, and this is simply that. Similarly, what is IRR? In the IRR, you forget everything else. What do I want? How does that matter? What if its fair value is 90,000? Could I tell the shopkeeper, give me this 1 lakh machine for 90,000 because that's its true value? He would simply say, it's 1 lakh, take it or just leave it. It's a simple matter, isn't it? You calculated the fair value, but it has no bearing. At the shop, you'll get it at the price it's being sold for. Like when you go to a 5-star hotel and have a cup of tea, the bill comes of rupees 1000. You won't argue that fair value of tea is 10 rupees since it's available for 10 rupees at an outside stall. There, that 5-star waiter will kick you out just like that. You get out of here first. Understood? So there, you pay him 1000 rupees. So fair value has no bearing. In reality, you will get the item at the market price. So friends, you see, what do I care about required return or what I want? Because this machine is available for 1 lakh in the market. If I buy it from the market for 1 lakh rupees, then what kind of return will I actually get from this? Please tell me that. Forget everything else, you'll get it for 1 lakh. Just forget fair value. Now what do I want to see? If I buy it for 1 lakh, what return will I get in percentage terms? Tell me that. So friends, if I invest 1 lakh today, the future cash inflows I receive will include the return. So you tell me, how much return am I getting? So at what rate should I PV the future cash inflows to equal 1 lakh rupees? Why? Because future cash inflows include the return. And if I invest 1 lakh today, I'll earn on this principal plus interest. The future cash inflows include both principal and interest. So if I remove interest from future cash flows, what should it be equal to? Principal. What rate should I PV cash flows? The rate making it equal to the initial investment. That's the IRR. Suppose, for example, I haven't calculated it, but let's say this internal rate of return comes out to be around 14%. This means that I am earning a total return of 14% in this project. This is what IRR means. And you know, you've already covered this. In bond valuation, I taught bond yield, where you learned about YTM. This means investing in a bond at today's market price and then getting future cash flows. Find the bond YTM to know the actual return which you are getting. Did you understand? That was essentially the IRR we've discussed. With bonds, we called it YTM, and for projects, it's IRR. The names change, but the feeling and core concept are identical. You've learned this, still we unnecessarily get confused. These are basic things. I can't go into more detail due to time shortage. This is a revision video. Look ahead. Next method. And modified internal rate of return, MIRR method, also called the terminal value method. This too will occasionally appear in a question. In this, you are calculating the project's IRR, but modified. Modified how? In this, you make an assumption that all cash flows you receive during the life of the project, you will reinvest them in the market at the discounting rate, whatever your required rate of return is, the discounting rate at that same rate until the end of the project's life. And in the last year, I will get back all the cash flows. See what I am doing in this. I will get 30,000 every year. As I receive 30,000, I'll keep reinvesting in market. So 30,000 received from project that is invested until last year. So in the last year, I will get the money with interest. Similarly, what was invested in the second year, in third year, and in fourth year will also be received with interest in the final year. So you'll be getting that money back with interest. The fifth year's amount will be directly received in the last year. It has no interest component. So in the last year, for example, the total amount which I found after summing up, I am getting 1,70,000. In this question, it becomes simple that I am investing 1 lakh at time 0 and will receive 1,70,000 in last year. So where did intermediate cash flows go? I was reinvesting them. I am getting total in last year. So now in this case, with this assumption that you are reinvesting all the cash inflows and in the last year, you are receiving all the cash flows with interest. So in that case, calculate your IRR, and this is called MIRR. At what rate should I PV 1,70,000 so that it is equal to 1 lakh? You can either do interpolation or there's a direct formula for this. Remember, zero coupon bond. The same thing happened there. You invest once and in the last year you get redemption. So the YTM calculated for that, it's the same formula. YTM meant IRR, right? The MIRR formula is the total amount received at project end divided by initial investment raised to power 1 by T. T means project life, how many years until you get the money, then minus 1. The formula and logic are identical. For derivation, refer to detailed lecture or security valuation topic, it's explained there. Alright, that's done. Now, the last method is adjusted present value, APV. This is in your syllabus and has an important question on it, so let's check it out. The APV method is quite easy and you're calculating an adjusted present value here. But how? Here you want to see that in my project I will invest money. and I'll earn money, we'll manage things, then we'll check the NPV. But in NPV, I want to see if I fund the project from equity, what's the NPV? And I also keep some debt. Keep a little debt. Along with the equity, the money which I will bring, I should bring some from debt too. So what difference will it make to my NPV? So I want to consider both facts. If I invest money in the project, bring money from equity, and then also bring in debt, what difference will it make? Will it make any difference to NPV? Absolutely. It makes a difference, a slight difference. How it does? You will understand now. First, we will calculate the base NPV. This means that you will assume that all the money which is invested in the project which I've brought is from the equity and I have no debt. In the question, there will actually be a date that you took some money from equity, some from debt, but you have to assume that I took all the money from equity, keeping this in mind. Now, calculate the project's NPV by discounting cash inflows using the cost of equity. You've already calculated these cash inflows from the project because you know how I've taught you. You just have to PV them with what? KE, cost of equity. When I'm taking cash flows of equity, meaning I'm assuming I brought money from equity, then what will be the discounting rate? It will be of equity, it will be KE. It's that simple. Then the project's base NPV will be obtained. Next, you need to add the effect of debt. Debt has a positive impact and it increases NPV. How does it increase? Why NPV increases with debt? Because in debt, what happens? Interest is paid. So sir, interest is paid, that's a loss. In a way, if interest is being paid, it's not a loss. Do you deduct interest in your cash flow calculations? No, you don't. But sir, interest is paid, isn't it? Money goes to equity too. Equity also has a cost. That's what we call KE. Equity holders also demand return. They don't give money for free. They just don't have fixed cost. Their cost is also there. Don't bring interest into the picture here. Okay? Don't think about it. We never consider it. Then what to consider? Is there any benefit due to debt? The interest on debt, you get tax savings on it in income tax. It's allowed as an expense. On debt and debt of interest, you get tax shield and you get savings. So tax saving. Sir, that tax saving will happen every year because interest is paid annually. So that annual tax saving is a benefit due to debt. So we will PV it because it will happen in the future. So PV it. Discounted using pre-tax cost of debt. See what we are doing here. Then we will calculate base NPV. PV cash flow with KE. Now what about debt's effect? For example, suppose that my debt and the interest on my debt is 1000 and 1000 every year. So how much tax? 30% means tax saving of 300 at 30%. This allowed expense saves 300 in tax annually, right? 300 rupees is saved annually and that's a benefit. You then have to PV it. But what rate will you use? The discounting rate matches the cash flow. What is the cash flow related to? Debt. So whose discounting rate will it be? It will be of debt. This should come to your mind. So this is tax saving on interest. So you will PV it with the debt rate. Now which debt rate? It will be pre or post tax. Will you take the pre-tax rate? Now sir, pre-tax cost of debt. Why PV using pre-tax debt cost? Think about it. You are indeed doing PV of the tax saving and this is already a tax amount. Now you won't have tax on tax, right? Do you know what post tax means? Subtracting tax from it. Are we supposed to subtract tax from tax? It's a very basic fundamental. Tax is never deducted from tax, is it? So you will PV this with the pre-tax cost of the debt. Please remember, it's very simple. There's also a question that I've made you do. You will get the adjusted NPV. Understand this much, the rest of the details were told in class, so you're ahead. Next, the impact of inflation on capital budgeting decisions. You can call this an advanced level topic. Until now, we have been discussing basic and intermediate concepts that were necessary for you to understand. Just remember the NPV method because that's generally what's used in all questions. Let's see inflation's impact on capital budgeting decisions. When you are making capital budgeting decisions, how will you account for inflation, meaning rising prices? Sir, what is this? Whenever you calculate the NPV of a project, as I said, what will happen in the advanced pattern? You will calculate NPV, but you will keep doing advanced things in it. So whenever you calculate the NPV of a project, the cash flow discount rate will be inflation adjusted, meaning nominal. Nominal means inflation adjusted, in which you have also considered inflation, adjusted it for inflation. What's this, sir? Let's clarify with an example. Look, I had estimated that my cash flows, which I would get 30,000 every year from my investment. These will be the annual cash inflows. For example, suppose how did I calculate cash inflow? I will sell 1000 units every year. And one unit sells at a price of 30 rupees today. So according to that, I get a cash inflow of 30,000. Right now, ignore costs and other things for now. They are insignificant. This sales value, just assume it as cash inflow and let's not overcomplicate it from learning perspective. So this is my cash inflow. So what is this cash inflow? It's without inflation. Cash flow without inflation is called in real terms. Okay, this is your real cash flow, which means that we haven't included the impact of inflation. When you work in practical life too, you first estimate cash flow normally. You see that in future so and so units will be sold. According to that, today's price is this, so this much sales will come. And this much is the variable cost today. This will be the variable cost for these many units. This will be the fixed cost in the future. Calculating this way, you obtain cash inflows, and these are in real terms. But you have missed an important impact. That's inflation. Won't prices increase? Today you are selling one unit for rupees 30, but will you sell it for 30 per unit every year? Look, are you not going to increase its prices in the coming years? My inner voice says I'll increase my selling price annually. So consider its impact too. Similarly, the variable cost, see if it includes labor cost in manufacturing. So for the laborers, today I can hire them at the daily wage of 500 rupees. I have hired labor at 500 rupees per day. Can you hire labor at 500 rupees per day next year? No. Labor will demand 10% increase next year and then 10% every year. Sir, who will properly account for its impact? This is about adjusting for inflation. You have real cash flows and now make them inflated, meaning nominal cash flows. Real, meaning your cash flows without inflation. You will have to make them inflation inclusive. And then when calculating NPV, you must include the impact of inflation in them. Now you might say that I had already done all the working by adding inflation. Then friends, this topic is not for you. Understood? Let me tell you the questions for this topic are separate. Then it has no further role. You can tell by looking at the question directly. If inflation etc. is given, you'll understand it's a question from this topic. It's very easy. So look that how will you give the impact to it? It's a very easy impact. First, how will you convert cash flows from real without inflation to nominal with inflation? So if the inflation rate is given as the same for all years. For example, you are told the inflation rate is 10% per annum. It's simple. Suppose year 1's real cash flow is 100. This is your real cash flow at first year end. First year inflation is 10%. Add 10% to 100 and the total comes to 110. How will you calculate it? Real cash flow into 1 plus inflation rate to the power of t. 100 into 1 plus inflation rate. 10% meaning 0.10. Power t shows cash flow time for 1 year. It's power 1 with inflation added. The second year's real cash flow, which is 250 at year end, they needs inflation added to it. Add it normally. How will you add it? How much inflation should I add to 250? It's 10% per annum. Sir, the 250 cash flow is at second year end. Okay, in the second year. So sir, 10% inflation in the first year, then 10% in the second year. So 250 plus 10%, then plus 10%. Yes, it's 250 times 1.10 to the power of 2. Third year cash flow is 300 into 1.10 power of 3, meaning real cash flow for that time into 1 plus inflation rate with power corresponding to the time. You'll get a simple answer. It's just mathematics and nothing else. Second scenario, if different inflation rates are given for each year. For instance, inflation is 10% in the first year, 9% in the second, and then 8% in the third year. So how will we calculate this? It's simple. Let's see year 1. Real cash flow 100. Nominal is 100 times 1.1 for the first year. Now look at the second year 250. Add inflation to 250. First year's 10% means 250 plus 10%, and for the second year 9% will be added. So how will you do this? 250 into 1 plus inflation rate of year 1 into 1 plus inflation rate of year 2. That is 250 into 1.10 into 1.09. Similarly for third year. It's 300 and you will multiply this by 1 plus the inflation rate for year 1, then year 2 and finally year 3. So into 1.10 into 1.09 into 1.08. Nominal cash flow for third year. I have written down the formula for you how it works in this case. The nth year's nominal cash flow. I've explained it this way. It's very easy basic mathematics. There's no need to write all this down. Just keep this in mind. Never apply inflation to depreciation, remember. It's based on historical cost. Like a machine bought today having a 5-year useful life. Sir, in 5 years that depreciation will be charged. What does depreciation have to do with inflation? It's not an actual cash outflow, is it? We are just recording it in the books. The machine was bought at historical cost. We are just writing it off in a way. Okay, so this is not an actual cash outflow. Never apply the inflation rate to this. Don't affect it with inflation. Should you inflate depreciation too? Absolutely do not do this. Ignore inflation on it. As I said earlier, if you're making cash flows nominal, your discount rate will be nominal too, and everything has to be inflation adjusted. I have told you many times, the type of cash flow determines the type of discounting rate. As I've often explained to you that the discounting rate always corresponds to the nature of the cash flow, firm, equity or debt. I have been explaining all these things. This is the very primary basic logic of FM. So if cash flow is nominal, then your discounting rate should also be with inflation. How do you convert the real discounting rate without inflation to the nominal, inflation adjusted rate? The formula is here showing how it's calculated. 1 plus real rate of the discounting into 1 plus inflation rate minus 1. It's simple. Now, how was this formula derived? I'll quickly explain, but without too much detail. Suppose your required rate of return is 12%, meaning I want a 12% return. Now think, if I talk about the first year, how much money do I want at the end of the first year? If suppose I invest 1 rupee, at the first year's end, you'll need 1 plus 12%. I want 1 plus 12%, that is 1.12. I want 1.12 at the end of the first year. Now a question will arise, do I want 1.12? By the end of the first year, sir, there will be 10% inflation. Inflation is 10% every year. Then I need 10% more on this, meaning I need 10% extra of 1.12, right? If I invest 1 rupee today, by the first year end, with a 12% required return, I'd want 1.12. I've explained this. But there will also be 10% inflation, so you can never add it directly there. How to add it to the return? Now look. You'll need to add extra 10% to this. You will then take that 1.12 and apply 10% more for inflation. That's 1.12 times 10%. If you look at it normally, you know what's happening mathematically. 1.2 into 1 plus 10%, what is 10%? Inflation rate. What was 1.12? It was 1 plus the real required rate of return. So it's 1 plus real return into 1 plus inflation rate. Now why are we subtracting 1 from this? Because the value that comes with the final value you get, what will it be? You will get the total amount you need at the end of the first year, including principal. We're only talking about return, not the principal. It was 1 rupee, so minus 1. It's clear now. That's all there is to it. I've explained it logically. Otherwise, you must remember this for your exam, because this topic is now complete and truly very easy. Now look at the second part of this chapter. Techniques of risk analysis in capital budgeting. This chapter covers advanced concepts. It's the most important part. It's the most important part. Generally, if questions come from this chapter, they are from this part. Questions in your exam are majorly formed from this part. This is a very easy part. You'll finish it quickly, and it's the most important. Everyone look here. Techniques of risk analysis in capital budgeting. Whenever you make capital budgeting decisions, there is risk involved in them. I am making a capital budgeting decision, so there is risk involved. So I need to identify that risk, mitigate it, reduce it. So there are some techniques to analyze risk. There are some risks while making this capital budgeting decision. You need to find out those risks. What is the risk? How much is the risk? We try to identify and correct this. So there are some techniques for it. That's what you have to study here. You have many techniques. We will do in this part. So what is the risk in capital budgeting decisions? What is the risk we face? We didn't see any risk. Are you talking about calculation error? Look, calculation error is not a risk. Making a calculation error in your capital budgeting decision is your risk, so no marks. We are discussing risk in capital budgeting, and even if all your calculations are proper, what could that risk be? Understand this. In capital budgeting decisions, I said invest 1 lakh in this machine. I will get cash flows of 30,000 every year. I predicted this, made an estimation. But is my estimation correct? Not necessarily. Anything can happen in future. No one has seen future. I thought this scenario is such today that these cash flows will be received in the future. But anything can happen in future. The economy can go up and down. Governments can change. Anything can happen in the future. Cash flows I have thought of, it's not necessary they will be the same. They can be more, they can be less. So sir, what is the risk more or less? Risk is on both sides. Positive, negative risk is on both sides. But we generally measure risk in terms of downside. Suppose I thought 30,000 will be cash inflow every year. If it's more in the future, it's a definite benefit. Listen students, who is thinking about the extra benefit? We don't need to worry about that, do we? Getting more benefit is great, you'll get more cash flow. But if I will get less than what I thought, then I could be in some trouble. Thinking of 30,000 cash flow, I had seen that NPV was positive and accepted it. But if the cash flow drops in the future, my NPV might be ruined, I might incur a loss in the project. Future is uncertain, our estimations are merely that, and this is the risk. So how will you manage or reduce it? Keep this in mind, it cannot be completely eliminated. But you can definitely try to reduce it by applying techniques and then analyze exactly how much risk is actually involved here. We'll look at its techniques. The very first technique is conventional. Look, under conventional techniques, you have to study 3 methods. This conventional method is the easiest. If a question on this comes, then these are absolutely free marks. If you ask this question to a 5th or 6th grade school kid, he could do it. This question is that easy. Now, you'll see what this topic is. Conventional technique. Conventional means traditionally people have been following these techniques for a very long time. To incorporate risk in capital budgeting decisions, to analyze risk, conventional techniques, meaning these techniques I am about to teach you, people have been following them for a very long time. Now you think when we will talk about advanced capital budgeting for older people, this is the advanced technique. Look, it's very easy. Old timers thought that these were advanced. You'll see now. So these are old techniques, which is why they are not tough techniques. They are very easy techniques. First, risk adjusted discount rate, RADR method, risk adjusted discount rate. You'll understand it from the name itself. This technique says if the project you are investing in has more risk, then you should keep your discounting rate higher. And if the risk is low, then keep the discounting rate low. It's a very simple and logical point. Friends, it's simply that if there is more risk in the project, then with more risk, I would want a higher return. A higher required return is higher discounting because it's the discounting rate. If there is no risk, then keep required return low. In that case, discounting rate is low. This is normal. I'll explain with an example. Let's say if I give a loan. In front of me, there is my friend and there is some unknown stranger and I am ready to give loan to both of them. So you will feel yourself that you will give a loan to your friend at a very low interest rate. And to the stranger, you will give a loan at a higher interest rate. It's a simple fact. And the reason for this is that you trust your friend. And here you simply see less risk. And here with the unknown person, you definitely perceive more risk. So where there is more risk, you want more return. And where risk is low, you manage with a lower return. This is the rule of the world. When we discuss banks, risk is low, it's risk-free, and the risk-free rate is always low, right? That's what it is. Nothing else. It's a simple topic. What's in it? So the future cash flows we predicted of 30,000, they are risky. Now, how risky they are? Choose your discounting rate accordingly and PV accordingly. For a project's NPV using the RADR method, NPV is absolutely vital as advanced capital budgeting truly requires it. You just need to calculate NPV using this method. So the discounting rate you use should be risk adjusted discount rate. What will that be? Risk-free rate plus risk premium. Risk-free rate plus risk premium. Friends, what is the market's risk-free rate? Suppose risk-free rate is 5%. If I invest somewhere risk-free, I will get a 5% return there itself. If there is some risk in the project, whatever the risk, I will demand a risk premium according to it. Whatever risk is there, I will add that risk premium. That's it. Move on. Sometimes question will directly give RADR that it is 14%. You have cash flow, you have a discount rate, do PV. That's all. There's nothing in this topic. If not given, it states the risk-free rate and project premium. To make the questions longer, since this topic is very simple, they will not even give you the risk premium directly in the question. So sir, how will we calculate the risk premium then? I explained the logic for that. It's the exact same logic I gave you in CAPM, security valuation. Look, suppose the firm's minimum required rate of return is 15%. Sir, what is this? I am a company, I have some existing projects running. Now, I'm investing in this new project and I want to evaluate it by the RADR method. So from my existing ongoing projects, I'm definitely looking for some kind of return, right? I'll need some return from them too, won't I? For existing projects, I would already know how much return I need since I'm already running the business. I'll have a firm's minimum required return. I need this much return from existing projects. This is the return from existing projects. This is assumed. Now avoid other interpretations and we won't discuss all that. Understand what I'm explaining. From the existing project, I need a 15% return. Tell me, can I calculate the risk premium for this existing project? So if my risk-free rate is 5%, then the firm's required return minus that rate is 10%. Sir, for existing projects, I need a 10% risk premium. Sir, what's my new project's RADR? A 5% risk-free rate and a 10% risk premium for 15%. No, it's not that direct. Look, this was the risk premium for the existing project. Based on the risk in the existing project, will determine the risk premium for the new project according to its risk. For the new project's risk, you'll simply find its risk index, and that index will be provided to you in the question. Do you know what the risk index tells you? It indicates how many times riskier the new project is compared to the existing project. In a way, it works like a beta. In a way, it functions like beta. What's the new project's risk compared to the existing one? If its risk index is 1.2, do you know what that implies? If existing project is 1 risk and new is 1.2, if the existing project risk was 1 and I asked for a 10% risk premium, then with a 1.2 risk, I will ask for 1.2, making it 12%. What's my RADR for the new project? Risk-free rate plus risk premium, which is 17%. You must have understood. It's very basic and exactly the same. The CAPM formula which we saw, it's there with the same logic. How do you calculate the risk premium? Risk premium is firm's required return less risk-free rate times project's risk index. All data is given, that's the technique. Then next is the certainty equivalent approach. What do you do in this approach? Look, the future cash flows, I've figured out that this cash flow might occur. I've made an estimation of the expected cash flow. But cash flows are risky and may not be exact. So do one thing. This technique says that the future risky cash flows which you have, you should remove them from risky cash flows and convert them to certain cash flows. Meaning, you see how much of it is a guaranteed amount that you will definitely receive. Figure out the amount you are sure to get. For example, I estimated 30,000 cash flows for 5 years. However, they are risky and not guaranteed to be exact. The certainty equivalent approach involves practical tasks. Exam data will be provided for you to simply grab free marks. So, in practical life, you need to see how much of this cash flow is guaranteed to be received. The company's analysis determines the guaranteed amount it will definitely receive. This is called certain cash flow. Suppose for the first year, the company said 80% of 30,000 is confirmed. So that's 24,000. For the second year, 90% is received, which means 27,000. I carefully checked for each year how much was confirmed. These percentages, they are written in decimals. To convert a percent to decimal, divide by 100. So 0.8, 0.9, 0.7, 0.6, 0.10. 30,000 times 0.8, that's 24,000. You will have these amounts. These values I've written, they are called certainty equivalent coefficients. Meaning, this much portion of these cash flows is certain. 0.8 means that in a cash flow of 1 rupees, a cash flow of 0.8 rupees is certain confirmed. Just take the confirmed cash flow and remove the risky part. Consider confirmed one. You will be given the risky cash flow along with its certainty equivalent. Your task is to find the normal, certain, risk-free cash flow. Now, you will calculate its present value using the risk-free rate. Whenever you use the certainty equivalent approach, you should always discount these cash flows at the risk-free rate because they have now been converted into guaranteed amounts. Because I'm absolutely certain to receive these amounts, this guarantee means they are risk-free. If cash flow is risk-free, then the discount rate should also be risk-free. When I deposit money in the bank, I know the interest I'll get, and this is why it's risk-free. Likewise, I am sure to get this money from the project. For PV, use risk-free discounting rate because cash flow is risk-free. Don't make this mistake. The certainty equivalent approach is simple. Take risky cash flows. Use the certainty equivalent coefficient to convert them to certain cash flows and then find their PV with the risk-free rate to get the NPV. To get certain cash flows for time T, multiply expected cash flow by certainty equivalent coefficient. T means the cash flow, year and discount rate. Will be your risk-free rate. This is your. This specific point is now complete. Certainty equivalent approach. Next, the utility approach. It's not even part of your syllabus, but our institute included it, likely from copying questions, a practice they have had for a long time. This approach is not expected in exams, and if it appears, it's free marks. So don't invest much time. I'll also tell you just a little about this completely rubbish approach. Look what happens in this approach. In this approach, we now talk about estimating multiple future cash flows from the project for a single year. For example, let's say my project has a life of only 1 year, a 1-year life. So in 1 year, I can get these cash flows. In the coming year, I can get these cash flows from this project. I figured this out. So I can expect these cash flows from my project over its 1-year life. I've made all the scenarios. Now, do you know what to do? In this approach, the company assigns a utility value to its cash flows. If this cash flow occurs, then what benefit does the company will see? The utility value, meaning how much benefit is perceived, company itself creates and maintains utility function which will be given. Look, I'll explain with an example that what the company does. The company has set 100 as its base utility, the value 100. What does this mean? If the company's utility comes above 100, a company is performing well, the project is good. But if utility is below 100 means project is bad. 100 is normal utility for company, normal benefit. The company has a utility function and it's given in the question. This specific cash flow then will have this utility value. It's directly given in the question, just assign utility values for each cash flow. Now, whatever cash flows you had estimated for that year, each cash flow will have a probability and their total is 1, right? Multiply utility value by probability, then sum it for the project's expected utility. Meaning, how much benefit do you see from the project in terms of expected utility, in terms of utility value? Select the project with the higher value. It's a useless approach. Finished. You don't need to overthink this. It's a simple approach. Now, look further, the sensitivity analysis technique. Sensitivity analysis technique. This technique is very easy, but when you start solving its questions. The questions for this technique involve a lot of mathematics, a lot of calculations, and are very time consuming. Assume this. If this question comes up, it's very time consuming. You must calculate very carefully because even a small error can make the question go wrong. This technique involves a lot of calculations, which is why people find this topic very strange and get irritated with its questions. Otherwise, the topic was easy and I'll explain it now. Look here. Before this topic, understand the NPV we calculate for a project. The NPV we calculate for a project uses many factors, variables or parameters, whatever you want to call them. To calculate NPV, we need to use many factors, which you can also call parameters or variables. What all is used? What do you need to calculate NPV? Initial investment. Also, project cash inflows are required. Sir, to calculate cash inflows, sales volume, unit selling price, unit variable cost, and fixed costs are needed. Apart from this, the discounting rate for PV. Project life, what's its duration? You'll take cash inflows for that duration, correct? All this data needed for NPV calculation, we call them factors, parameters, or variables. To calculate the project's NPV, you will have to use these things. And all these things, they actually involve risk in some way. But how is that possible for all of them, sir? Risk from cash inflows is understandable, but how do all these things cause project risk? You see, all are based on estimation. Sir, how is that possible? There's estimation in cash inflows. We know that there's risk in it. And what about others? Discounting rate? Absolutely. I said I need a required return of 10%. Sir, after a year, I realized the project carried much more risk than I understood. After a year, reality became clear. Now I'm thinking I need higher return. I calculated the NPV incorrectly. A higher return meant your NPV, meaning cash inflow PV, would be lower. Higher rates reduce value. Covered this in basics of AFM. There is no need to repeat it. And this too can lead to project risk. We talk about the downside, meaning risk, the kind that causes us loss. If cash inflow increases, that's a risk, yet it brings us benefit, so we need not to worry. Higher discounting rates are a risk. Decreasing cash flows, PV and NPV. Project life has similar impacts. I thought 5-year project life. But after starting the project, I realized it would not run beyond 3 years. I had calculated PV for 5 years, but it will only run for 3 years. What if project life is reduced? Even initial investment has risk because this 1 lakh must be paid today and involves estimation. I asked the shopkeeper the machine price and he quoted 1 lakh rupees. I said, okay, I'll just calculate capital budgeting, then return. He said, okay. I came back, did the calculation and its NPV was positive. After 2 days, I told the shopkeeper, you were selling this machine. Here is 1 lakh rupees now, hand it over. NPV was positive, but shopkeeper said it's not 1 lakh. Today its market value has become 1.2 lakh and do you still want it? Market value is 120. Now tell me if you want it. Now what should I do? I'd calculated on 1 lakh. You'll see practically initial investment isn't instant. We call it zero time and calculations are done accordingly. Don't argue about 2-day impacts on calculations. The calculation just needs to be done normally. Is it okay? But I'm telling you, this also has an impact. Because for large projects, such as building a factory, this was a small example. So, their capital budgeting decision can take 1 or 2 months for projecting cash flows and all. Calculations don't take time, projections do. In just 1 month or 2 months, planned initial investment can change a lot. While building the factory, building itself will be constructed, investment will happen in it, investment in assets. Initially, I had estimated the investment would be 1 crore. But after spending, it was 2 crore rupees. There can be risk in the initial investment too. This is also a kind of estimation. Did you understand? So from a question standpoint, you need to do it as you have been. Right now, I have just explained that all these things which can have risk. So you calculate the project's NPV using many factors, parameters or variables which I have explained to you. These factors bring project risk from estimations. So in this technique, we want to see this. If in any factor, when I say factor, you must have understood all things I mentioned like initial investment, cash inflows and things inside them for calculating cash inflows. Cash inflow needs sales volume. If you estimated 1000 but the actual is 800. So that can also happen. There can be problem there. If there is slight issue there, entire cash inflow will change. So in every factor, if there's a change in any factor, meaning any particular factor, so due to that, what impact will it have on the NPV? We analyze that. We call it sensitivity analysis. Meaning, if my initial investment, I said 1 lakh, but the initial investment is 1,10,000 instead of 1 lakh. So what impact will it have on my NPV? How much will my NPV change? If any of my factors change by a specific percentage, we need to find out how much my NPV will change and what exact impact it will have. This calculation is sensitivity analysis. Means I want to look that. Now tell me which factor is my project's NPV most sensitive to? Meaning due to a change in which factor does my NPV suddenly decreases? Suddenly decreases. So which factor is the NPV sensitive to? We often hear that this person is very sensitive about his mother. As soon as you say something about his mother, he'll flare up instantly. We just need to see that due to change in which item, which factor, is the project's NPV suddenly flaring up, meaning getting worse. Project is getting ruined means NPV is becoming zero. NPV decreasing means NPV is decreasing for us. We are talking about that for now. If a factor changes by a particular amount, by a particular percentage, then how much will the project's NPV change? We need to calculate that. Our project will respond in what way? Now, to calculate that, to measure sensitivity. Sensitivity analysis is conducted using two methods. Both methods are different, but ultimately the crux and the decision you'll get will be identical. The way of thinking in both methods is different. The crux will be the same, just the way of thinking is different. So look at first method, its normal method and easy method, see what it is. Project sensitivity to a fixed percent adverse change or variance in each factor. All the factors which you have, what will you have to do with them? For all these factors, you will first take each one independently and ensure all other factors remain the same. And in it, you'll make a fixed percent adverse change or variance. And because of that, we'll see what impact it has on the NPV. How will we see it? It's a 3-step calculation, but it takes time. What's the very first step then? Let's cover it. For the very first step, calculate the existing project's NPV using the current values for all its factors. The question will provide initial investment, cash inflow, discount rate, and the overall project life. So just calculate that normal NPV. No problem with that, right? Calculate the normal existing NPV in step 1, and that's it. Now, for the second step, you need to calculate the project's revised NPV. You must also apply a fixed percent adverse change for each factor independently, as given in the question. Keeping other factors same. Sir, what was that? I mean, listen carefully. Initial investment, cash inflow, discount rate, and project life are in the question. So, you calculate the existing normal NPV. You already know how to find this. If the estimations we made remain the same. Now we want to see the sensitivity if there's some change in each factor. The question asks you that if every factor will change by 10%, then tell me which factor will be more sensitive for the project. This is what you've been asked. If every factor changes by 10%, sir, what kind of 10% change? Beneficial or not? We'll focus on adverse, not beneficial changes. If it's a beneficial change, say the initial investment decreased or cash inflows increased, we prioritize losses, so avoid beneficial changes. Always consider the adverse change. Okay. Don't rely solely on the question's wording. You must logically find where a loss occurs. You'll focus on the adverse 10% change. The question will specify it. So you have to check by changing each factor by 10%. And in that case, what will be the impact on NPV? Independently, meaning change one factor at a time. Suppose the question asks, if initial investment and cash inflow change by 10%, what happens to NPV? You tell me. You'll change these two by 10% and check the NPV impact independently, leaving others unchanged. First, what's your initial investment step? For initial investment, you will determine its new value, then calculate the revised NPV. Let's say our initial investment was 1 lakh. A 10% adverse change increases the initial investment rate by 10%. Adverse means more spending. A lakh plus 10% is 1.1 lakh. So you have the new initial investment and then calculate the entire revised NPV. Cash inflow, discount rate, project life, and other factors will remain constant, as will independently analyze each, keeping the rest unchanged. You've now obtained the revised NPV. When the initial investment increases by 10%, then observe the percentage change in NPV compared to your existing NPV. Subtract revised NPV, divide existing. Look, we just check the change against existing NPV, right? That's it. So why you think revised NPV is shown in minus? It's always a lower value. As we see adverse changes, revised NPV always drops. Otherwise, if we write it first, it won't make a difference. You should ignore plus and minus signs. This percentage change, it's seen in absolute terms. Just remember this. I've told you many times. It will be 20%. Do you know what this means? If the initial investment changes by 10%, the project's NPV will directly change by 20%. If it increases by 10%, then project's NPV will fall by 20%. Understood this point? Similarly, you were talking about annual cash inflows. Now, similarly, what do you do with the annual cash inflows? Reduce them by 10%. If cash inflows drop, a loss happens, then find the new inflow. Calculate revised NPV. In this case, keep the initial investment as original. All other factors, the others, will remain the same. This time, we independently change the cash inflow by 10%. We have the revised NPV calculate the percentage change. Suppose this comes 30%. What does this mean? If cash inflows adversely change by 10%, meaning they fall, then the NPV will fall by 30%. Understood? It was mentioned for two things. Calculate only for those mentioned. It was for two. In the third step, you have to make a decision which factor is most sensitive. Sir, it's the factor causing the highest NPV percentage change. Have you checked by changing both of them by 10%? You changed the initial investment by 10% once and found that the NPV will fall by 20%. And if you change the cash flow by 10%, the NPV will fall by 30%. So sir, both are sensitive. But which factor is most sensitive? What is the project more sensitive to? It is more sensitive from cash inflow. So if cash inflow drops 10%, then your NPV will fall 30%. It will drop it more. So it's more sensitive. Just like someone's very sensitive about their mother, they'll instantly flare up a lot. Similarly, if you talk about his girlfriend, he flares up too, but not much like earlier. He's sensitive to both, but truly most sensitive to his mother. So the same thing applies here. Cash inflow is the most sensitive factor. Analysis is complete. First step involves existing NPV and factor values. In the second step, calculate the project's revised NPV. Take a fixed percent adverse change in each factor independently, the percentage will be given. Keeping other factors the same, percentage change in NPV, you keep repeating this step, changing each factor for whichever factors it's asked. Third step, identify the factor causing the highest percentage NPV change. Now let's look at the second method. We have covered one. Next, I'll show you a class example. The second method, project sensitivity. You check each factor for the project where the NPV becomes 0, and then what is this second method, right? You really need to grasp this point in the first method of sensitivity analysis. The percentage change in a specific factor is provided and we calculate the resulting percentage change in the project's NPV. In second method, we talk about the NPV filling, how NPV becomes 0, meaning project gets ruined. A project becomes ruined when its NPV is 0, anything below that point is simply unacceptable. Project's ruined, making it unacceptable for me. That situation arises. Then what's the factor's percentage change there? By what percentage should each factor change so that it makes the NPV 0, so that it makes the NPV 0? Meaning, if the project's NPV becomes 0, in such a case, what will be the percentage change in your factor? What will be the factor's percentage change? That is what you need to calculate. So this is also a way of sensitivity analysis. First step, calculate existing NPV using current factor values. Then for the second step, calculate each factor independently. First, let's calculate initial investment. So what should the initial investment become so that what happens, your project's NPV becomes 0. Keep other factors the same. So this scenario, in this you will have to do mathematical calculations assuming X. A complete equation will be formed and mathematical calculation will be done. If your mathematics is strong, this method is manageable. But if weak, you must practice it thoroughly. Which method to use will be mentioned in question. If by mistake it's not mentioned, then use any method. Okay, so this method becomes a bit tough because mathematics gets involved. Okay, you've got the initial investment. Now, how much should annual cash flow be to make NPV 0? You'll set up the same equation using X for cash flow and find that amount. You'll find that percentage change. The factor's revised value will be the new initial investment amount minus its existing amount divided by that existing amount into 100. That revised value can be placed anywhere because for investment, if it increases, NPV becomes a 0 and that is a loss. If it falls 10%, revised value is less, just note that. You should ignore the plus and minus signs because the percentage change is always considered in absolute terms. Anyone considering the plus or minus signs will be wrong. You just ignore them and write it as you wish. So you will need to apply this step, this entire type of process for every single factor in the calculation. In the third step, the most sensitive factor is the one with the lowest percentage change. Didn't I just say the highest percentage change in NPV in the previous one? Understand the feeling. Here, it's about how much percentage change in the factor is needed to make the NPV 0. So suppose this happened. That your initial investment, if there's a 10% change in it, then it will make the NPV 0. And if there's a 15% change in the annual cash flow, then it has directly made the project's NPV become 0. So tell me, who was most sensitive here? Here. What was more sensitive here? Your initial investment. Why initial investment? Because just a 10% change makes the NPV 0. Annual cash flow needs 15% change to 0 project NPV. The most sensitive factor will have the lowest percentage change. Understand? Both methods yield the same result. Though percentage changes differ, one focuses on NPV, the other on your factor's change factor. But the final answer, the most sensitive factor, will actually be the same from both methods. You'll get more clarity from initial investment amount, annual cash flow discount rate, and project life are given. First, measure project sensitivity with 10% adverse change in initial investment and annual cash flow. What if initial investment or the cash flow changes 10% adversely? Existing NPV, apply PVA for 3 years to 50,000 at 10% and subtract initial investment. In step 2, if initial investment increases by 10% meaning adverse change. So calculate revised initial investment. On this calculate revised NPV, keeping cash flow same, their PV will be same. Percentage change in NPV. After this, if annual cash flow changes adversely by 10%, then calculate the revised NPV. Keep initial investment original and determine the NPV percentage change. If you notice, look here, there's a 41% change in NPV or a 51% change. Both factors will change 10%. So the cash flow is much more sensitive, because a 10% change in it causes a larger change. Now the second method. Calculate the project's sensitivity regarding initial investment or annual cash inflow, so NPV becomes 0. So you'll find what percentage change in factors makes the NPV 0. First, the existing NPV will be the same, then the second stage. Initial investment. How will you calculate it? PV of cash inflow minus initial investment gives NPV. This is what needs to be made, just form equation. Find PV of cash inflow minus initial investment. Assume X for initial investment and equate this to 0. You got amount of initial investment. If this amount is reached, then NPV will be 0. You can verify too. So let's see how much initial investment grows. There is a 24.35% change in initial investment, right? Then your NPV will be 0 for annual cash flow. What should it be? Let's denote it by X or A. I denoted it by A. You need to find out how much it should be, right? Multiply by PVF for 3 years at 10% minus the original initial investment equals to NPV 0 is desired. So you should found amount of annual cash flow. Annual cash flow is 40,209. This has decreased. If annual cash flow reaches this point, you will see a 19.58% change occurring. This is making NPV 0. What is most sensitive? Initial investment will make NPV 0 at 24% change. For annual cash flow, even if there is 19% change, it will make NPV 0. Annual cash flow is more sensitive. With this, sensitivity analysis has been completely covered with an example. You shouldn't have any problems. Now, look ahead. Statistical technique. Look now, all of you. Statistical technique. Statistical technique, they are very easy technique. You won't face any difficulty with them. If I were to say these are the easiest techniques in this chapter, it's also where exam questions mostly appear. Questions from this entire part appear in exams. In this section, the institute heavily focuses on statistical techniques, and this is also the easiest. But most students who have come from outside find this quite tough, because they have never studied them in a structured manner, and those who never study the syllabus like that, they just come to YouTube to watch questions. Those people will always have problems with concepts. Easy things will seem tough to them, and they will never be able to do the tough things. So they will always have problems. They will always say that the papers are very tough, exams are bad, ICI doesn't give marks. They will always have these problems, nothing can be done for them. So if they want to do it, they have to study properly. So if you study properly, like I will do now with an example, I will teach you this technique. You will find nothing easier than this. See, for capital budgeting decisions, we use a statistical technique. In this technique, you are going to use statistics. Using these statistics, we can analyze the risk. What risks can be there in the project? How much risk can there be? That all is analyzed. Using stats, mathematics is a very useful thing, as I explained to you. Statistics is a very terrible thing. We never understood statistics, let me tell you. You need basic stats that you have already studied. All that I'll be teaching you in this topic, we've already covered in our portfolio management chapter. Remember there, we invested in securities and shares, and then we calculated their expected returns and also their standard deviations, right? You'll find these exact same concepts and techniques applying here too. Instead of security and share investment, we'll now focus on investment in project or investment in machine. There's nothing more to it in this topic or in this technique. It is very easy. Now look what we are doing in this, okay? Just like when investing in securities were there. When investing in securities, we used to see that for the next year, we could get multiple returns. Their probabilities were given and we would calculate an expected return by averaging them. Similarly, when we invest money in a project, if the project has, say, a 3-year life. In a 3-year life, I'll see in the first year, I can get this cash flow or this one. Like this, I can estimate multiple cash flows. With probabilities, we can identify scenarios. If the economy is such, these cash flows and their chances become clear. Year 2, cash flows with probabilities. You've estimated it. So, multiple possible scenarios can be formed. Like I showed you by making a chart that these cash flows are forming in your first year. Then year 2, if 30,000, same 5-6 scenarios. Then if it's 25,000, then again there are 5-6 scenarios. Many paths can be formed. Many paths can be formed, meaning many of your scenarios are possible. So each scenario can have its own NPV. Meaning, simply put, the crux is this: I can estimate multiple cash flows for each year with probability, and then I will explain all these things in detail. If there are multiple cash flows, it simply means your project will naturally have various NPVs. You see, we have 3 different project NPVs. My project might give NPVs of 10,000, 8,000 or 12,000. Different NPVs would arise from varied cash flow estimates, and their probabilities are given. So can't you find out what NPV you will get from the project on average? What will you get on average? So you will call that expected NPV, probability into 1. That's the calculation I've taught it. What I taught expected return, that is expected NPV. Return was just in percentage terms. Here NPV is in amount terms. Logic, formula, everything will be applied exactly the same. So I won't go into much detail here. All references will be of the portfolio. That's why I said earlier in this chapter, all references will somehow come from previous chapters. There are no special things in this chapter. Understood? So you will learn this. This is your statistics, calculating the expected NPV of the project using the probability distribution of cash flow. You need to calculate standard deviation of expected NPV. My expected NPV came out to be 10,400. But what's guarantee that this NPV will be received? No guarantee, right? We had 3 scenarios, 10,000, 8,000 or 12,000, and other outcomes are possible. Even without 3 scenarios, is deviation possible from the average expected NPV we calculated? Absolutely. Then find that risk and deviation, meaning the standard deviation. You calculate risk by finding it's a standard deviation in NPV. It can come. Suppose I calculated it. For example, it's 2000. Okay, I've written this amount as an example. The standard deviation came out to be 2000. Do you know what this means? My NPV, the expected NPV on average is this much. But on an average, a deviation of 2000 can also occur. Meaning, it can be 10,400 plus or minus 2000. Risk is on both plus and minus sides. Our concern is the downside, right? In our decision making, our range will clearly indicate that our NPV can be from 8,400 to 12,400, as this directly reflects 10,400 plus or minus 2,000. Now, according to this, I will see whether I should invest in it or not. So this is all you have to do. Exactly the same thing we did in portfolio when investing in securities. The standard deviation of the security. Calculate the expected return. After that, we used to calculate standard deviation. Same formula, same calculation, everything will be the same. Got it? See how to do the calculation. Here, you use decision making to find the expected NPV. You calculate standard deviation and coefficient of variation. This is the statistical technique. We also saw the coefficient of variation in portfolio. It will come up here too. First, understand the other things. I'll explain that small part. Now, regarding exam questions, 4 scenarios or cases are formed and 4 types of questions are created. Simply put, in common language. The institute asks 4 types of exam questions. And the first one is when question provides project NPVs with probability distribution, just like my previous example. It will give 4 or 5 NPVs. It will give their probabilities like this could be. The probability means these are chances of NPVs for project with these respective probabilities. So if a question like this comes up, you'll understand by looking. In the exam, 4 types of questions can be formed. How to identify that question? Just look at it. I will explain everything. How will you know? The project's NPV and probability distribution are given. Understood this scenario? This is scenario 1, the first one. If such a question comes, it's easy and the working is in 2 steps. What's the first step? First, for expected NPV, as I have taught you, we average it because this is basic statistics. Average is done by probability. NPV into probability, do that and then total it. We shorten expected NPV to ENPV. How do we get it? By summation PX. This sign is called summation in portfolio PX. P means probability and X means. What are we calling X? Here, X refers to our NPV. Wherein there are various NPVs for the project, the different NPVs. You sum up the probability into NPV and that process is called summation PX. Summation means to total and to total is simply to sum. Multiply probability by NPV and total it, that's the formula. So memorize this formula. This is just for your revision. No need to cram it, no need to write it in the exam. In the exam, just calculate because formulas aren't marked. This is just for reference, directly from the portfolio. Yes, so you can link that it's the exact same thing, nothing new. You can directly average the rest. In portfolio, there was an extra point, all based on past data. In this equity, we took past returns and averaged them. This cannot happen in a project since project can only have future data. We're starting a project today, entirely focused on the future, never the past, right? Its decision making can only be done based on future data. Remember this, there's nothing like past data here. Second step will assess project risk, which is the standard deviation. Variance must be calculated before standard deviation. All the reasons for this are in the portfolio, so you must revise that. If someone here is asking for the reason, trying to understand, and then needlessly saying that sir doesn't explain anything anymore, then excuse me, this lecture is not for you. You never studied with me. You have come to pass time because I have already given reasons in such detail that no one else can, and this is my guarantee. Go study with anyone who is teaching these days. This topic is explained in detail within the portfolio section for regular batch students, and for others, as this is a revision, I'll share it. For external students, the portfolio revision uploaded for you all has the concept explained in detail. Alright, you can refer from there as well. For even more detail, you should go to the regular batch. Variance of project is denoted by sigma square. Formula is summation p into x minus ENPV whole square. Sir, what is this formula? If I briefly explain it, the rest will be recapped from the example, like the portfolio. The formula is summation px minus ENPV whole squared. X minus ENPV means the respective ENPV. X minus ENPV means you calculate the NPV deviation similar to x minus x bar. In portfolio, we use x bar here. I wrote ENPV deliberately. However, x bar is also fine. Remember, we're doing capital budgeting now, so don't get lost in portfolio. I deliberately wrote ENPV. We found deviations and squared them. Why is that done? The reasons explained there, not here. Multiply by probability, these deviations are obtained, but which will it be? Multiply by probability and total it to get variance. Then you multiply by probability and total. The sum total of probability into deviation square of NPV from ENPV. Variance is obtained, take square root of it to get standard deviation denoted by sigma. Look, an example clarifies it all. NPV is given to you along with their probabilities. Find the project's expected NPV and standard deviation. Steps 1 and 2 are always done together, just like we did in portfolio. How will we calculate project ENPV and standard deviation? You've got the formula, but we'll now use a table. It's solved this way. You'll do it like this for the exam. The formula just recaps the process. This is how it is solved. Revise portfolio and then you'll find this very easy. I've written down NPV, which is X. I wrote their probabilities. NPV into probability is ENPV. Now deviation. Now we need to calculate standard deviation to see how much change happens. Deviation is NPV minus ENPV. But if it's 8,000, our 12,000 average indicates minus 4,000. It could be 10,000, we calculated 12,000, that's minus 2,000. Sir, if it's 12,000, the deviation is 0. It can be 14, we calculated 12, average means 2,000. So is calculating deviations clear now? Now look, we squared the deviations. We get the square of deviations. Now we need to multiply these squares by probability, because which deviation should we pick? So average them by multiplying with probability. So deviation square into probability gives you the variance, because you have already squared the deviation and get variance. Now that you have the variance, take its square root, because you've already squared it unnecessarily. You'll get standard deviation. Why do we square and all? I've discussed the logic in detail, told you again. That's it, it's done. It's very simple, but calculations always take some time. Here, I told you one thing in class, I'm telling you that again here. Because the external students don't know and they make mistakes. What common mistakes do you often make? This exam question is very easy for you to understand now. But still, you make some silly mistakes while calculating the deviations. You calculate deviations wrong and then everything is 0. How do you miscalculate? You need to look at deviation from NPV to ENPV. Logically, these are the only deviations possible. These are the deviations we can see according to the future. That's it, logically. But in the exam, we are in such a hurry that we make a silly mistake. You know what we do? Instead of taking this deviation. So what deviation do we calculate? We take deviation right here. And this is a very common mistake which many of the students make. Even the external students, you see, they consistently send me common doubts about this very topic. Students often have this doubt, thinking deviation is wrong, and they even declare the question itself wrong. They ask me that, sir, is your book solution wrong? No, both are correct. Your calculation is wrong. So what kind of deviation is this? What are you doing? You multiplied NPV by probability. You are differentiating that amount from ENPV, so what kind of deviation is that? That's not deviation, you calculated something else. And you must avoid making silly mistakes. Next, this is the second scenario. The question in exam. If perfectly independent future cash flows from a project are given in the question with probability distribution, then how will we do it? Look, I've explained one of the scenarios and this is the second. Understand this well. After this, you will never face any difficulty in any subsequent scenario. So now you should focus thoroughly on understanding this part well. Understand this well because you'll find the entire crux here. Yes, the major point of this topic. Look in the question, the NPV is not given here. With probability, what are you given instead? You are given independent, perfectly independent future cash flows from the project. Sir, if we remove perfectly independent, we understand future cash flows. We will understand perfectly independent later. First, understand future cash flow. You have been told year 1, year 2. The 2-year project has possible cash flows and their probabilities. For both years, cash flows with probabilities are given and NPV with probability is not given. They haven't calculated NPV for multiple scenarios. They said that in the first year, you will get these cash flows and their probabilities. The second year shows 3 possible cash flows with probabilities and with the 2-year life. Calculate expected NPV and standard deviation. How to calculate now? Now look, I will explain it to you by drawing a tree. You don't have to draw this in the exam for this topic. You will understand it through this, and then this topic which has been drawn will be useful later in the last scenario. Take a look. Let's create a decision tree structure starting at time 0. I will invest 1 lakh. Now what can happen in the first year? You'll either receive a cash flow of 30,000 or 10,000 or 20,000. I have opened 3 branches from here. Any can be received. Their probabilities were noted from the equation. This is purely for explanation. What about second year? It can take any cash flow from 25,000, 5,000 or 15,000. If 30,000 was received in year 1, then anything can be received in second year. That's why it's perfectly independent. Means in first year, any of these 3 cash flows can occur, and in second year, any of these 3 can occur. There is no dependency here. In the second year, any of these 3 can occur independent of the first year's cash flow. In the second year, any of these 3 can happen. It's perfectly independent. The cash flows of both years are independent. Did you understand? Meaning the future cash flows of the project are not dependent on any year. They are all independent. In the second year, if the first was 30, it can be 25. It can be 5,000 and it can also be 15,000. 3 branches then emerged, and I noted the second year's cash flow probabilities. If it was 10 in the first, then any of 3 can happen in second year. If first had 20, any of the 3 options are possible in second. Okay? So I've made this entire chart. This is a complete chart of cash flows showing possible cash flows. Now if you notice from here, so your project, you see how many scenarios can be formed in it, how many cash flow scenarios can be formed if you notice and want to find out. How many paths can be formed, or how many scenarios, we call them paths or scenarios. So look, one scenario could be that we get 30 in the first year and 25 in the second year. Another scenario could be that we get 30 in the first year and 5 in the second. It's possible. So now look at the possible scenarios. One could be that we get 30 in the first and 15 in the second. Then another scenario is 10 in the first year and 25 in the second. 10 in first, 5 in second. 10 in the first, 15 in the second. Similarly, another could be 20 in first and 25 in second. 20 in first, 5 in second. 20 in first, 15 in second. Meaning these different scenarios are possible, which are called paths or scenarios. So if you count them, there are total 9. 1, 2, 3, 4, 5, 6, 7, 8 and 9. Meaning 9 different cash flow scenarios are possible. So what cash flow streams? What scenarios are possible for my project? I have understood all that. Got it, right. What possible cash flows and scenarios can the project yield? Now if anyone had thought a bit, then they would quickly grasp what to do next. Sir, it's very easy now. I know the possible scenarios. So calculating each NPV is straightforward. For all possible paths, calculate their NPV. You can calculate NPV. First path is 30 cash flow in year 1 and 25 in year 2. With the investment and discount rate, compute PV and get the NPV. Similarly, you can calculate for paths 2, 3 and 4. Calculate NPV for all possible scenarios. The probability of all scenarios. Sir, the question will provide this and you can find each scenario's probability. How? It's very easy. We call it joint probability. You can find probability for each path or scenario. Look here to know how. Look. What is the probability of getting 30,000 in first year? 20%, 0.20. So it's a 20% chance. First path says 30,000 in year 1 and 25,000 in year 2. First year has a 20% chance of getting 30,000. The chance of getting 25,000 in second year is 10%, 0.10. So sir, first there is a 20% chance of getting 30,000. Then there's a 10% chance of getting 25,000. Meaning 10% of 20. First there's a 20% chance, then a 10% chance of that. It's simple. First there's a 20% chance of 30,000. Then there is a 10% chance of that for 25,000. It's simple. 0.20 into 0.10. This is 0.02. This is joint probability or probability of entire part. Probability of this scenario. See the second part. First year has 20%. Chance of 30,000. And for 5,000 probability is 0.60. In the first year, there's a 20% chance for 30,000 cash flow. Then there is 60% chance of 5,000 in second year. So the joint probability of this path is 0.20 and into 0.60, which is 0.12. This is how it's calculated. So how do we do this calculation? So the formula is very basic mathematics, not part of the syllabus, but you should know it. It will be useful later, so I'm explaining it. So you will find out the probability of each path, each scenario, which we call joint probability. You can try totaling this, it will be 1. And if it is not 1, then there's an error in your calculation. So you got this? So the NPV of every path. The probability of each path, isn't this like the first scenario question I told you? Where multiple NPVs with probabilities are given in the question, it's the same. The first question case you have studied so far was essentially a subsequent part given, and NPVs for each part were already calculated from the cash flows. With NPV, it's given with probability. It directly asks for further calculations, not making you work hard. Sir, what's our exam approach? For perfectly independent cash flow, simply identify the path and its NPV probability is then known. After this, it's NPV into probability expected NPV standard deviation. So now we will proceed like this, alright? You don't have to do this. If attempted, then one question would consume hours since 9 paths have emerged. 9 paths emerged, calculating each NPV would take too much time. And think I have only taken 3 cash flows for each year. So in an exam question, each year might have 5 or 6 cash flows. I have only used 2-year life here. Exam's life can be of 3, 4 or even 5 years. You know what, the chart that's made here, it will go outside your notebook's sheet. If there were even 3 years in this, then 27 paths would be formed here. If only a 3 cash flow estimation for each year was given and the life was 3 years, then 27 paths form. Even 3 hours would be insufficient for you to solve one question if you do it this way. So this method cannot be applied. You'll definitely need a shortcut. And whenever perfectly independent cash flows are given in the question with probability, different method is applied and it involves 4 steps. If you want to do it this way, you can. If anyone wants to verify, the answer will be the same as the shortcut I'm about to tell you, which the institute also uses. The answer is still the same. Whoever feels like they want to verify, then you can do any of this if you have the time. Otherwise, use the shortcut that I'll tell you, and note that it's not that short. It takes about 15-20 minutes once you have practiced it. What you need to do is very easy. You have a 2-year life and the cash flows for both years with probability are given. First, what to do in the initial step? Forget NPV. In this case project, NPV isn't given. Cash flow with probability is provided for each year. So do one thing, what you were doing with NPV, do that with cash flows, meaning find the average of cash flows. What's the first year's expected or average net cash flow? You find that by totaling cash flow into probability. Meaning, find the first year's expected net cash flow and for other years. Meaning, find out the expected net cash flow for each year. First step, you will find out the expected net cash flow NCF for each year. Calculate the NCF for each year separately. ENCF will come similarly summation PX. What does X mean here? Cash flow from project, right? Sum probability into cash flow from project. In the first year, multiply cash flows by their probability and sum them. It's averaging like NPV, right? So here for each year, you calculate a separate ENCF, which is the average cash flow. Everything is understood. This NCF is calculated. Now what to do? You got ENCF. After this, you need the project's ENPV and risk. The project's ENPV can still be calculated, but you also need the project's risk. So now what do we do with cash flow? We will work with that itself. So find out risk in cash flow. What will be the second step? Risk in cash flows of each year. First step, average ENCF of cash flows for each year. In second step, find out risk in cash flows. How much risk can there be in each year's cash flow? If there's risk in cash flow, that will be risk in NPV. That's what gets reflected. Then you should find the risk within each year's cash flow. Separate workings are needed for each year's cash flow. An example will provide clarity. Calculate variance of cash flows for each year. So now sigma square of cash flow is summation P times X minus ENCF whole square. This is the first year's cash flow and its ENCF. First year cash flow is this deviation, means cash flow minus ENCF. Take deviation of cash flow from ENCF. Standard deviation is the square root of variance. Understood? You'll do the same for cash flows, calculating for each year separately. Find standard deviation of cash flow for first year. For the first year, cash flows and probability yield ENCF, the steps 1 and 2 will be together. What is it each year? So now deviations X minus ENCF. X minus ENCF, X minus ENCF. Deviation square. Deviation square into probability. This will give variance. You took square root of variance. So you'll get standard deviation. You have the standard deviation for each year's cash flow. Once you have completed these 2 steps, your question is solved. Calculate the expected NPV of the project for each step. It's very easy. You had found average cash flow for each year. Calculate the PV of ENCF. Now you have the ENCF for each year. Calculate its PV minus initial investment to get expected NPV. How will you calculate risk in project? How do we determine project risk? It's risk we found in cash flows, that's project risk. The cash flow risk is project risk. But sir, cash flow is future based and project risk is assessed via today's NPV. So future cash flow risk needs discounting to its present value. So you will PV the risk of cash flows. You will PV the risk of cash flows. So look what you have to do. Understand this. Whenever you calculate risk, you have to calculate it in terms of variance. Always remember this, the logic is the same as in portfolio. It's calculated in terms of variance. The project's variance, sigma square, then how will it be derived? The project's risk is the future risk from cash flow, so find that in present value terms. First year's cash flow standard deviation into PV factor of year 1. Multiply the second year's cash flow risk by its PV factor. Repeat this for all project years, then calculate. PV it, then total it. You'll slightly modify this approach. We calculate it with variance, and since variance is squared, you'll then definitely square this. So now do standard deviation of each year's cash flow into the respective year's PV factor. Then it's whole square, and then you have to total it. This gives project variance, then its square root is the standard deviation. Understood the point? It's very easy. So if we take project variance, a doubt might arise in your mind. Couldn't I have done it directly like this? If I had taken cash flow variance and its PV instead of standard deviation, that would be wrong. And why? You're taking variance here, but a normal PV factor with variance squared, it also needs squaring then. So when we do the whole square, it automatically gets squared. And what's the logic? If I don't square the PV factor here, I'm telling you, look, this variance is understood. You're asking why square the PV factor? If you didn't grasp this, I'll explain it differently. Look here, if we don't square the PV factor, then variance will come. We do under root for standard deviation, so under root of entire variance will happen. PV factors were normal, their square root was taken in a way, taking square root of entire variance. Its square root was taken and it's wrong. Keep the PV factor squared beforehand, so that later when we take the square root, so there's no impact. Did you understand? Keep this in mind, and then how will project variance be calculated? Cash flow standard deviation for year 1 times its PV factor whole squared plus the same for year 2 and so on. It will continue for the number of years, and this continues for the entire duration of the project. Then standard deviation of project, variance of project under root. I have explained this. Now look at an example. You're told some possible cash flows from projects that you will receive in next 2 years. Year 1. Cash flow with probability. Year 2. Cash flow with probability, discounting rate, initial investment, expected NPV and standard deviation. Sir, you have shown this example, but this example doesn't say it's perfectly independent cash flow. Cash flows exist. As you learn about future scenarios, we understand that somewhere you will say dependent. How will you know in the exam? It will be given in this example of topic, so you assume it's independent. What about exam questions? Sir, even in the question bank, I arrange them topic wise for you. Topics have subtopics. This one has 4 categories, so I have arranged the questions category wise by difficulty for identification. How to find out in the exam? I told you in class 2, it's very easy to find out. I'll tell you that. When I teach you, I cover concepts and also explain exam techniques, telling you what to do. In class, I even tell you where silly mistakes can happen. Many things have been told. It's not possible to tell all that now. But I will share all the main points over here. So look, whenever nothing is said about cash flows, they are considered perfectly independent. This is the assumption in silent case. I'll show you it's written in the notes, and I will discuss it further later. For now, this is perfectly independent. Then let's check an example. First, calculate ENCF. Then find each year's cash flow standard deviation. Both steps are done together. Steps 1 and 2, year wise. So first year one's cash flows probability. So year one's ENCF. So cash flow minus ENCF for year 1 deviations, square of deviations into probability. Variance of first year cash flow is obtained under root first year cash flows standard deviation. Now, you will do the same working for the second year, and more years of data will increase the work in this question. Then in third step, ENPV of project, take ENCF, calculate PV minus initial investment ENPV. Fourth step, project standard deviation means risk. Multiply each year's cash flow standard deviation by PV factor. Squared it, got the variance of the project, took its square root. It's very easy if you are going to follow it this way. And let me tell you, this particular calculation, people confuse it to no end. Have you understood what I explained? People never understand that how this came about. It's such an easy topic. See, it's very easy if you study things conceptually. Follow the notes, follow the format I give, understand things conceptually. Everything will seem easy. This AFM is the easiest subject in your syllabus. and I always tell you this. So you must have understood this. You will not face any difficulty in this. So look now. Listen, if the question just asks for the project's ENPV and not standard deviation, then you don't have to calculate the standard deviation of cash flows. It's unnecessary. Cash flow standard deviation isn't for ENPV. You calculate standard deviation to get project's standard deviation. Just remember this, don't overdo it. Even if extra calculations are done by mistake, it won't matter. But time will be wasted, remember that. Now for the next scenario, if perfectly dependent project cash flows are given with their probability, what's our approach? This kind of scenario or this case. This is also called scenario analysis. We will explore why it's named that and what it entails. Now I will explain it to you. Okay, first let's properly understand what these perfectly dependent cash flows actually are. It's mentioned in the question. Look, cash flow in year 1 can be any of these three with probability given, and this seems perfectly independent. But now you should focus here. What in year 2? If it's 30 in year 1, and then it will be 25,000 in year 2. If year 1 hits 20, year 2 will be 15, and if year 1 is 10, year 2 will be 5,000. So here you can see two different cash flows, right? But these different cash flows of year 2 are fully dependent on the first year. See, I'll show you by making a tree. Look. Here the initial investment is 1 lakh and first year cash flows can be 30, 20 or 10 with probabilities given absolutely same. Now in second year, if it was 30 in first, then it will be 25 in the second. There is no other choice. It's confirmed to be 25 in second. And suppose for a future question, year 3 is 26. Similarly, if first year is 20,000, second is confirmed 15,000 and third 14,000. Similarly, if first year is 10,000, then it's confirmed that second year will be 5,000 and the third is 7,000. You'll notice that multiple cash flows in the second and third year are perfectly dependent, relying completely on the first year's outcome. If the first year's cash flow is known, the second and third year's cash flows become fixed. Perfectly dependent. You'll understand by looking. So it will be mentioned in question or you'll understand by looking. But sir, what if it's not mentioned or clear just by looking? So how will we do it? So look, in perfectly dependent. Sir, you only made 3 first year scenarios. Couldn't 4 or 5 also be possible? Sir, for perfectly dependent cases, exam questions show 4, 5. Yes, scenarios can be formed, though exam questions generally stick to 3. Always remember, for perfectly dependent, the question will discuss about 3 scenarios or streams, the best, most likely, and a worst case. If you find this wording in a question, it indicates perfectly dependent. Best case means everything's favorable, and you get the highest cash flows. Everything will be to against us, worst case. And everything will just continue on as normal. Nothing much in our favor in the economy, nor unfavorable. It continues as it is, meaning most likely. This is how we bifurcate it, meaning when you have 3 possible streams or 3 possible scenarios of cash flow available, then it is perfectly dependent cash flow. It will be directly stated, or you'll understand by looking, or specific wording will clarify, right? Then this is perfectly dependent. Otherwise, perfectly independent. You can easily judge that it's done in class. Remember, only 3 paths will form in question because it will provide only 3 scenarios. So only these 3 paths are truly possible and no other scenarios can be formed apart from these. Okay sir, calculating NPV for these 3 scenarios is quite manageable. So there's no other shortcut, you just find NPV for all 3 paths. Find the NPV for all 3 paths. The probability for each scenario, like best, most likely or worst case, is available. So for the NPV of all 3 scenarios, it became exactly like case 1. For expected NPV, multiply NPV by probability. Joint probability shouldn't be like this here. If probability is 0.253, then second and third year will be same. It can definitely be written in a table, like it's here. You might think the second year has the same probability, but that's not how it is actually. Here probability is scenario wise. What are the probabilities for best, worst and most likely cases? It's probability in this case. And if you verify logically, look, in the first year, there's a 20% chance, which means a 30,000 cash flow. It's really simple. If 30,000 occurred in year 1, then in the second year, 25,000 is confirmed to be received with probability 1. And it's confirmed that 25,000 will change to 26. 0.2 into 1 into 1, which results in joint probability of 0.2. You can calculate it this way. Joint probability is not calculated this way. I have explained the logic. Same for the first year. There is 0.50 probability of 20,000. Once 20,000 occurs, year 2 is guaranteed 15,000. And there is guarantee of 0.40. Joint probability is 0.15 into 1 means 0.50. Got it? This probability is scenario wise here and it will be used for NPV. So here you can have three possible scenarios or streams of cash flows. Worst case, most likely case, best case, it's talking about perfectly dependent cash flows. Calculate NPV for all three scenarios. You have the NPVs with probabilities for all three. Now calculate expected NPV exactly like the same as case 1. Project risk using deviations from expected NPV. Look at example. Three scenarios are given. Probabilities and cash flows, it's perfectly dependent. It's not written anywhere, but it's known. Discounting rate, initial investment, same as NPV, standard deviation. Calculate NPV in all three scenarios. First is, look at worst case. Year 1's cash flow 1000, year 2's 500. NPV was calculated for this and then for most likely and best cases. You have all three NPVs and their probabilities. You can then calculate ENPV. Deviation squared times probability yields variance. Then standard deviation is its square root. Third case is completed. Now look at its final and fourth case. Moderately dependent future cash flows from a project are given to you with probability distribution. This means moderately dependent, meaning such cash flows are given in the question which are neither completely dependent nor completely independent. There is some dependency in the cash flow. Only one type of question is possible for this. We only have one or two such questions that comes in exam. And you will only understand this by looking at the question. So it will be written and you will very easily understand by looking that it is moderately dependent. I have created a scenario in front of you. Its initial investment. First year's cash flows, either 30,000 or 10,000, come with probabilities and they always occur according to these. First year is independent, so no need to count it and no one can really see that. Beyond that, what was said for second year? If it was 30 in first year, in the second year expect 35, 40 or 25 with probabilities provided. If it was 10 in first, second year cash flow options are 15, 20 or 5,000 with probabilities. If you have noticed something, you can see the second year's amount isn't fixed and it's not perfectly dependent on the first year, which implies complete dependency. It's clear it's not perfectly dependent. It's not even perfectly independent here. And why? Look at the second year. Here, for example, it could be 35, 40 or 25 if the first year's cash flow is 30,000. And if first year's cash flow is 10,000, it won't be any of these three in the second year. In the second year, it's 15, 20 or 5,000. Suppose out of three, two cash flows were written here and one was different. Even then this same scenario. So what has been done here? In the second year, there can be multiple cash flows different for each branch. It will depend on first year's cash flow what the second year's will be, but there isn't one fixed cash flow for second year. This means there's a dependency. The second year's cash flow depends on the first year. It's not fully independent but dependent. It is dependent. So if the first year is 30, the second year will be one of these three. If first year is 10, it's one of these three. So there's a dependency on the first year, but it's not perfect dependency because any of those cash flows can occur in the second year. Are all six scenarios simultaneously possible? Can all six scenarios happen simultaneously? No, they cannot. All these scenarios are not possible. These are different cash flows. In the perfectly independent case, what did we find? If you exactly remember, in the perfectly independent case, the second year cash flows were 25,000, 5,000, 15,000. Second year's cash flow is 25,000, 5,000, 15,000 independent of first. That was perfectly independent. The second year's fixed amount was unrelated to the first year. With moderate dependency, anything can happen in year 2. But what happens in the second year will always depend on what the first year's outcome has been. If first year's 10, it's any of 3, making it moderately dependent. So it is dependent, but not completely. If year 2's flow was 38, like year 1's 38, so it's perfectly dependent. But that's not given. This is moderately dependent. You'll understand it just by looking with an example. So how many paths are formed? If you look here, you have 6 paths forming. You'll have to create these paths. No shortcuts will work here. If the institute gives a question in such case, it will try to make it short, and a question shorter than what I've written isn't possible. It's clearly visible, 6 paths are formed. This one, and this one. Similarly, this one, and this one. These 6 paths are formed. Then calculate the NPV for each path. Each path has joint probability 0.60, 60% chance of 30,000, 20% chance of 35,000. 0.6 into 0.2 gives the joint probability. Its calculation, though not in the syllabus, will be useful. Once joint probability and NPV are found per path, rest is identical. For moderately dependent cases, you simply have to create paths because no shortcut applies here, and so you must create a decision tree where you then show every possible cash flow path and calculate each path's joint probability. Second, calculate each path's NPV. Third expected NPV is NPV into probability. In the fourth part, calculate the risk. Square the NPV deviations, multiply by probability. Its square root is a standard deviation. For example, 2 years cash flows given. Year 1, 1000 or 2000 with probabilities. Then what's written for the second year? Look, if year 1 was 1000, second year's cash flow will be one of these three with probability. And if year 1 was 2000, also one of those three with probability. So 3 different cash flows given for each case in second year as per first year's cash flow. Dependency is moderate, not perfectly dependent, because a single cash flow for the second year isn't specified. It's moderately dependent, not perfectly, and you will understand this upon seeing the question. So discount rate. The initial investment and details are all given. First create the decision tree and then identify the paths and calculate their joint probability. In step 2, calculate each path's NPV from its cash flows. Steps 3 and 4 are similar. ENPV and standard deviation. NPV into joint probability is ENPV. NPV minus ENPV deviation. Square it then into probability variance under root standard deviation. This is complete. Now look at the note here. You must assume cash flows are perfectly independent. If question has no hint or information, then how will you identify this? If question states perfectly independent, perfectly dependent or moderately dependent, then no problem. If the question says nothing, but it includes wording like best case, worst case, most likely case or similar phrases, then you should understand it's about perfectly dependent cash flows, clearly indicating that type of scenario. And if no such information is provided, if it's moderately dependent, you'll easily recognize. If no other hints are provided, then you assume it's perfectly independent and proceed. And that's it. Secondly, regarding decisions, the question will typically provide 2 projects, first project and second project, and calculate ENPV and standard deviation for both. If you have to select one project from multiple projects, how will you decide? If you're asked to compute NPV for decision making, then you will select the project that has a higher net present value. If you are asked to select by standard deviation, then that indicates risk. Lower risk is better. So select the project with lower standard deviation. If it talks about selecting the project based on the coefficient of variation, since the coefficient of variation indicates risk, the lower it is, the better. Choosing a project with a lower value is better. How is coefficient of variation calculated? It's like portfolios. Standard deviation by expected return. Project's standard deviation is here. Instead of expected return, we use its ENPV. This indicates the amount of risk taken in this project for each rupee of NPV. So it's simple. The less risk you take to earn 1 rupee of return, the better. So the lower the coefficient of variation, the better the project will be. Select the project with the lowest coefficient of variation. The statistical techniques topic is now complete, and next, the final technique, decision tree analysis. What is this? This decision tree analysis is completely useless, junk technique. Now, when I say this, some people get offended, as I've mentioned in class. Some people feel, sir, this is knowledge. How can you call knowledge garbage or junk? These are often those who might seem very knowledgeable, but then they are the ones who achieve little in their lives and only criticize. Look, I'm not calling knowledge as garbage. I'm teaching you here for the exam. I'm teaching for the exam. So I'm just saying it's irrelevant from the exam's point of view. Your institute doesn't focus on this at all, and as of now this chapter isn't even in the syllabus. The institute keeps updating its courses from time to time. This chapter was removed earlier, however it is now back in the syllabus. When in syllabus questions were rare, one appeared every 15 or 20 years. The institute copies and pastes material. For one old question, we review this topic which is largely useless and you can skip it. I'm teaching based on that question, but you can mostly ignore this topic. Look. This particular technique is used for projects where you will need to make future investment decisions that are based on some future event. I invest in this project today, but there will be a future event. On that day, I'll again face decision points about whether I should invest in the project or not. This means your project involves a sequence of decisions over a period, and one is made today with another required again in the future. In such case, you need to apply the decision tree analysis technique. Working involves 4 steps. First, a decision tree diagram will be created. To ensure full understanding, I will now explain this diagram using an example. I've already used such example before. Let's look at that example. Look at this example. Suppose I have a decision point. This is the day 1 decision. Should I invest or not? We call this a decision point because a decision must be made. Remember, in this chart, a decision point is represented by a rectangle. Invest or not invest. After the decision is made, a chance point or node will then appear, which we will simply call point B. At this point, a chance outcome will then appear. The outcomes will either be success or failure with probabilities given based on the investment decision made. So let's see where this is generally used. First understand that and then you will get more clarity. This is typically used in the software or pharmaceutical industries. For instance, let me take an example. I want to create a software. I want to create a software that can automatically dub videos into any language perfectly. For this software, I first need to conduct research to check if its creation is possible. Once all the necessary research is complete, then I can begin the development process. So the first decision is, should I invest in research or not? The first decision point is invest in research or not. If I do not invest in research, then nothing happens and that is nil. But if I do invest in this research, then there will certainly be a chance and an outcome will emerge. What will be the outcome? After investing in research, the research will either be successful or it will fail. You will estimate these chances and probabilities, or the question will provide them, either success or failure. If the research succeeds, then another decision point will arise from there. If it fails, I'll have to make another decision, even if it fails. What will those decision points be? Invest or not? Now look. If the research is successful, should I now start developing the project or not? I must decide again. You might say if it is successful, then start development. But there will be development costs. So now I need to see if the development cost is so high that the benefits don't justify it. If NPV is insufficient, then decide whether to invest. Getting my point? Similarly, a decision point D will come when my research will fail. Then you might ask, what's there to decide? The research for the software I plan to make for this project unfortunately failed, which means a specific software cannot be developed. But the outcome that came from that research, it failed for that particular part, but I noticed that the findings from this research could allow me to create a new different software that might help me with something else. It can be made. I found that out from the research. So this new alternative software, should I make it or not? The decision point is invest in it or not. Understood? This is decision tree analysis. Once you make a decision, should I invest today for research, and a future investment decision is needed. In this case, the working is very simple and involves creating a decision tree diagram, which I'll explain. Like this. Second, calculate the NPV. Whenever a tree is formed, calculate from the end and work backwards. Look at the end of the tree. At the last decision point, calculate the NPV of the investment decision. What NPV will you get if you invest? And based on that, see if it's beneficial to invest or not. So, look at the decision point C. What cash flows I will get if I start developing the project? PV minus. The investment NPV 100. It means it's beneficial. At decision point D, NPV was minus 20, so it's not beneficial. And that's beneficial. You got it? Find this out. I can make a decision here in the future. Today, at decision point A, I must decide whether to invest or not. That's about future. What will we do? We will keep moving forward from the future. We'll work forward in the tree. Now what do you have to do? You found the NPV at decision points C and D, what the benefits are, and whether you'll invest or not. Now, at the outcome node, the chance node, find out an expected monetary value. Meaning, what expected value do you see there? Expected monetary value is a technical term having no meaning. It's simply the expected value you see at that chance outcome node, which means what is the expected monetary value for success or failure. In both the cases, you have the NPV known and the probabilities for success and failure are given. So, you need to calculate probabilities for both outcomes and the benefit, or NPV for each outcome. But if the NPV is negative, simply take that benefit as 0. Look. If NPV is 100, probability for success is 60 and failure is 40%. So for an NPV of 100, there's a 60% chance. If the NPV here is 20 and there's a 40% chance, why take 0? Just think about it. If the NPV there appears to be minus 20, I would be a fool to invest. No sensible person would ever want to invest. I'd get no benefit out of it. Never take the negative value. So 0 into 0.40. The expected monetary value appears to be rupees 60. So at the chance outcome, chance node B, you can see a value of rupees 60. Step 3 is complete. Then in step 4, you have to make the initial decision. Compare the initial investment amount with the expected monetary value that you see at chance node B. At decision point A, the investment in research will be rupees 40. The expected monetary value for that investment is 60 rupees. Since it's all benefit, make the investment. The expected monetary value is from chance node B. If that's for a year later, questions do not specify such time frames. If time is given, then bring the expected monetary value to PV. It's logical. I mean, don't get into too many ifs and buts, but if you must, I've given an answer for that too. Anyway, this useless topic is now fully complete and this is all you need to see. Let me tell you, people waste time on topics not at all useful for you. If you study from someone else, this chapter is made overly complicated, filled with all sorts of unnecessary information, interlinking things randomly. And that's with completely illogical linking. They've filled it with complete garbage, even though in a way it's not even part of your syllabus. Questions rarely appear from this topic. If some question comes, it will most likely be a repeat. Decision tree analysis technique. Students, do not waste your time on this at all, and there's no harm in observing what others are doing. But if you prefer someone else's teaching, focus only on what's useful for your exam material. Avoid their complex and irrelevant knowledge, especially if emphasized. If you don't understand my teaching, you can skip watching me. But if you watch someone else's, then apply your own judgment, because I know there's a lot of junk material out there. Now, we'll see the third part, other decisions. We have completed the major part of this chapter, covering risk analysis techniques, and the most important questions for the exam came from that part. Now we will quickly complete the third part, which is other decisions in this chapter. When we talk about capital budgeting, and then within capital budgeting itself, one aspect we consider is project investment, whether to invest in a project or not. We understand this as decision making, but that's just one branch of capital budgeting. Capital budgeting decision is a very broad field, and evaluating whether to invest in a long-term project is just one single branch or simply one specific part of it. It also includes other decisions. Otherwise, why would it be called capital budgeting? We could have called it project investment decisions then. Capital budgeting is broad, and project investment is a branch which you have studied since intermediate, and we have seen its advanced level concepts and techniques. Now, capital budgeting also has other branches where you make other types of decisions. The very first among them is replacement decisions. You need to understand them as they are easy to grasp. Now please pay attention. Replacement decisions. A replacement decision means a decision where you want to determine if you should replace your existing asset with a new one today and what that decision would entail. Meaning, I have an existing asset, a machine I bought and kept. I want to examine and see, should I replace my existing asset with a new asset or not? Should I scrap the current machine and bring in a new machine in its place? After selling this machine for scrap, should you replace it with a new one? This is the important decision. So how will this decision be made and what's its method? You need to understand. There are exactly two types of replacement decisions. The first is important, but the second is not useful and quite junky, though I will tell you about it. The institute also approaches it in a completely different way, where many mistakes can occur. That second type is not useful. You should study the first replacement decision. This is the most important one. Look, it's very easy. First replacement decision, should we replace the existing asset today? Should I replace my existing asset today or should I not? This is a very simple decision for us to consider. I have this machine, should I replace it? Should I scrap this machine today and get a new one in its place or not? Just that simple decision. Why do we need to make this decision? And before we study it further, let's understand why it's necessary. There are many reasons for this. We all know that as an asset gets older, its efficiency tends to decrease. As it gets older, efficiency drops because older assets don't have the capacity to produce as much. Bringing a new machine boosts production. For example, the old one yields 10,000 units yearly, and a new one will produce 15,000 units, and all will be sold. So with a new unit or machine, my sales will increase. Similarly, the older machines will require more maintenance. Because just like a person, as anything gets more older, its issues and illness increase and its expenses go up. It's the same with machines. As they get older, they demand more maintenance. A new machine will have lower maintenance costs and lower operating costs. A new machine for manufacturing might cost 10 rupees per unit to produce, whereas the old machine can have a cost of 15 rupees per unit. So a new machine has this advantage too. There are many advantages, which is why we want to consider replacing it. If only advantages appear, should we replace it? But now you need to consider this, that if I install a new machine, but installing a new machine is not free, because replacing the old one with a new machine will definitely incur an installation expense. So, is the expense I incur on the new machine worth the benefit I will get from it? You must verify this, then you might just calculate NPV. Calculate NPV. But it's not just based on NPV. We use a variation of NPV, incremental NPV. We'll modify it slightly. It's a slightly different method. Let me explain the logic behind it once, and after that it's very easy. Just understand the logic. Look, should I replace my old machine today or not? You must carefully assess the extra benefit that you are gaining from the new asset. Simply understanding the extra benefit from the new asset ensures overall better clarity of this topic. Otherwise, students get so confused and then ask why this is happening or why they are doing it. If you can logically feel, you'll understand it. This is something that can only be understood intuitively. There is no formula derivation as such. You can only understand it intuitively. What's the extra benefit we're looking for here? When I'm talking about scrapping this old machine and bringing a new machine in its place, is bringing a new machine beneficial now? For that, you need to see what extra benefit you are getting from the new machine. So let's say the old machine makes 10,000 units. The new one will make 15,000. Without replacement, the old machine still sells 10,000 units annually, right? If I calculate the normal NPV of the new machine, it will consider sales based on 15,000 units. Normal NPV takes total cash inflows. The new machine's extra benefit is only for 5,000 units, if you have felt this. So you have to look at the extra benefit, the extra cash flow. The extra is called incremental and benefit means NPV. For the new asset, you will calculate the incremental NPV. This means the same 4 steps for NPV will apply. Just add the word incremental in all 4 steps. Instead of initial investment, it will be incremental initial investment. And instead of cash inflows, it will be incremental cash inflows from the project. It's PV of incremental cash inflow, not just PV. And the last step, what will the incremental NPV be? PV of incremental cash inflows minus incremental initial investment. It is exactly the same concept, but now it entirely revolves around incremental cash inflows. You must have understood how and why we are doing this. And let's see how it's done. Calculating incremental initial investment is simple. For the new asset, the incremental initial investment will be the expense of bringing it in, including its purchase plus installation cost. This is like, if any, use only the given data. Do not assume installation costs if not given in the question. Just take the given data. This if any principle applies throughout the chapter. Purchase cost plus installation cost forms the new asset's cost. You may think this completes it, but more can be incremental. This is the cost of the new asset, and because we are replacing the old one, it will then be sold for scrap. If we sell it for scrap, we'll get today's salvage value. So that will be received. Money was spent on the new asset and received from selling the old one as a scrap. So the net amount spent on the new asset today minus current salvage value of existing asset. But if you sell the existing asset, there will also be a tax effect. You know that, right? Suppose the existing asset salvage value is more than its book value today, then tax will be payable. If book value is more than salvage value, there would be a tax saving. If tax payable, it would have reduced salvage value. If there's tax saving added to salvage value, as you'll receive salvage value and also tax saving. And then you will calculate this total amount internally. So internally salvage value plus or minus tax effect. Then that will finally be reflected. This final amount will be deducted from the cost of the new asset. This is quite basic and logical. You'll judge whether to plus or minus. The net current salvage value is then adjusted against the new asset's cost. It gets deducted. Did you understand? This gives you the incremental initial investment. Next, for step 2, incremental cash inflow. Incremental cash inflow from new asset. Now, the incremental cash inflows you'll calculate for the new asset. Calculate the new asset's annual incremental cash flow. So, what incremental extra cash flows will you get annually from the new asset? And there are 2 methods for its calculation and selection. You can choose your preferred method, but in the exam, you'll understand which method you can actually apply according to question's data. The method's application depends on the data in the question. Understand the method and its use becomes clear. First of all, how do we get cash flows? It's the same process. EBIT tax yields NOPAT and then you add back depreciation. For asset replacement, you will ignore working capital and such. There's no such thing as working capital adjustment here. Anyway, it doesn't usually feature in this chapter, so ignore it completely. So first, if we start with sales, what will be the extra sales due to the new asset? Take increase in sales. So let's say sales increase by 5,000 annually. So take 5,000. The new asset then brings annual savings in operating costs, reducing them by 2,000. If the cost is lower, that's a benefit, so add it. If the cost were higher, you would subtract. Cost is deducted from sales, but here it's given saving in cost. If an increase in cost was stated, it would be deducted. But generally, this will be the case because new assets are installed precisely to increase sales and save on operating costs. If a student questions whether a decrease in sales would be a minus, then yes, it would. Such a scenario is unrealistic. If a new asset is going to cause your sales to fall, then considering its acquisition would be a very foolish decision. It's absolutely confirmed that you're a foolish person if you're trying to make such a decision. Such a decision is utterly foolish. Such a scenario is not truly possible, and generally the scenario is as I've described. After accounting for expenses against sales, then subtract depreciation. With a new asset, Depreciation generally increases because its current value results in higher depreciation. Old assets depreciate less due to original cost, and new assets have higher depreciation. If we use the new asset, how much will its annual depreciation be? And if the old asset continued, what would have been its annual depreciation? Let's assume the old asset had an annual depreciation of 500. On the new asset, 800 annual depreciation applies, and this causes a 300 increase in depreciation, which is a cost. Then subtract this increase. This will give you the incremental EBIT. Deduct tax from this. Subtracting tax gives incremental NOPAT with NOPAT. Now add back the increased portion of non-cash item, which is depreciation, because we are working with incremental values. Depreciation incrementally reduced by 300. So add back only 300. Do not add back total depreciation, as calculations are based on incremental values. Then incremental cash flow is simple. This point is now concluded as I have explained. Now look at the second method. In the second method for cash inflow, you will determine the total annual cash inflow by using the new asset. What annual cash inflow from continuing the old asset? Find the direct net difference between them. You will get the same amount as in the previous case. I had verified this with an example. Suppose sales from old asset is 10,000 and new asset is 15,000, which is up by 5,000. And the cost with the old asset was 8,000. With the new asset, the cost will be 6,000. This means there's a 2,000 saving in operating cost. So for simplicity, assume no other changes in depreciation and tax. So the total savings from method 1, the incremental cash flow is plus 7,000. Now method 2. In the first case, how much is the total cash flow? 2,000 for the existing asset. And for the new asset, what's the annual cash inflow? 9,000. So 9,000 minus 2,000, 7,000. Any method yields the same answer depending on the question. If the question provides cash inflows for using the new asset and existing one, then this method applies. If the question details sales increases or cost savings, then method 1 is applicable. Next, consider the final year's additional cash inflow. You get this in the case of a project. When the new asset's life ends, an additional cash inflow, that is salvage value, is received. The new asset's salvage value is also taken incrementally. When sold, you get money, and any tax effect, either payable or a saving, will be plus or minus. But along with this, we are talking about incremental. Now look here, this is for the new asset. However, if we kept the old asset instead, it would also have had a salvage value on that day. You might assume the old asset's current salvage value has already been accounted for. The thinking here follows the opportunity cost approach. Here we consider if the asset remained unsold and continued. What extra benefit from the new asset? Let's assume from the new asset you'll get a salvage value of 10,000 at maturity. Suppose its book value on that day is also 10,000, so there's no tax effect. This 10,000 is what you get. If this new asset wasn't there, the old one would continue with a 3,000 salvage value as provided. You would get 3,000. This is the salvage value. If you were to get this, then remember, there would also be a tax effect on it. Let's assume a tax payable of 300 on this, so you get a net amount of 2,700. So you would earn a net of 10,000 by selling the new asset. But if the old asset had continued, there would still have been a cash inflow of 2,700 in the last year. So the incremental amount is 7,300. Got the point? That's all. Keep this in mind. Typically, questions aren't this detailed and are concluded here. Steps 3, 4 are simple. Calculate incremental cash inflow PV at discount rate. Incremental NPV of new asset, PV of incremental cash inflows minus incremental initial investment. If it comes out positive, the new asset should be replaced. If it's negative, then don't replace the existing asset. It's a loss. That's it, finished. The second type of replacement decision on second day. Should we replace the existing asset now or later? Should I replace the existing asset today or later in the future? Meaning, when should this existing asset be replaced? You need to decide when to replace the existing asset. Meaning, this machine I have, should I replace it today or 1 year from now? Should it be replaced after 2 years, 3 years, 4 years? When should it be replaced? If such a decision arises, how will you make the decision? There are only 2 limited questions on this. Those are very old questions from the institute that the institute has just been copying and pasting. If you try, you can find mistakes in those old questions. I have created a method for this here and given it to you, while others just solve that question using their own approach. Some people say it's wrong, so just memorize it. Others don't say anything and just solve it using some random illogical reasoning. You know, those YouTubers who solve things who themselves have no real knowledge but try to impart all sorts of wisdom to the world. So, the market and institute's affairs are not good. So for that type of topic, you must have understood what I meant by now. And having solved such questions in class, I've developed a proper method. What is it? The institute hasn't provided this method. By looking at the questions in their material, I clearly understood their viewpoint, their intentions, statements, and working concepts. When they make these decisions, it's not based on incremental NPV. The institute bases decisions on total NPV per scenario. It computes total NPV across scenarios, then decides. So here I will explain based on total NPV. When I explain this, many things might come to your mind, like, sir, this other method could also have been applied here. There could have been an easier method, a better method for incremental NPV. Why this way? Can we do it differently? In practical life, thousands of approaches exist. For the exam, with few questions, if one appears, just follow the institute's method. They haven't documented this, but I provided based on their question solving perspective. I'll explain the logic, nothing will be illogical. For this approach, do not delve into ifs and buts because it is utterly useless and unlikely to appear in the exam, as the institute knows its method is rubbish. But since they've provided it, I'll explain it. Its exam chances are minimal, so skipping it won't matter. How is the working done? It's done in 3 steps, of which the first and third steps are very easy. Only the second step will take some time. What happens in the first step? For the new asset you are considering, the one you're thinking of replacing the old one with, calculate its total normal NPV. Let's assume the new asset I'll bring will last for 8 years. Now should I replace the old asset today, or after 1 year, or after 2 years? If the question asks for such decision making, should I replace this asset today or after 1 year or 2 years? Suppose the question asks about these scenarios and new assets useful life is 8 years. So you will first calculate the new assets NPV from its total cash inflows. Calculate its PV minus initial investment for NPV. This is the first step and you'll find it easy. So you've calculated this. And if I replace it today, then the second step is calculating the total NPV for various scenarios. What is various scenario? First, if I replace my old asset today, scrap it, what will happen? If I scrap it, I'll get the current salvage value of the existing asset today. Salvage values tax effect? No. The questions lack the tax data and it won't come up. So as I said, either these same questions appear or not. There is no chance it'll come. If this tax aspect comes up, then provide the tax effect. Otherwise, you can write many things. Okay, so focus on what's given. It's baseless point. It's not complicated, hence it's not detailed. And the other factors you'll manage. This chart won't come up, so let me clarify. If you sell the old asset today, you will receive its salvage value. Besides this, if you don't sell but bring in a new asset, you'll get its NPV. So the NPV of the new asset can be plus or minus. It absolutely can be. So new assets NPV can be in both plus or minus terms. So you'll get this. If you replace it today, what value do you see? The total NPV. We call this as the total NPV. Understood? It's very easy. This is the logic here. Now, if we replace the old asset after 1 year, scrap it after 1 year, what will happen? What does the institute say here? If you decide to scrap it after 1 year, you'll continue to run the old asset for that first year. So any cash inflow or outflow during that first year as given in question will be from this old asset. Consider the old asset's first year cash inflow or outflow at year end. Calculate its PV using the first year's PV factor because the decision making occurs today and we compare it based on today's time. The first year's calculation as replacement occurs after that period. It's the first year. Use the first year's PV factor. At first year end, the old asset is scrapped and its salvage value received. You'll always get the existing asset's estimated salvage value at the end of year 1. Then you can multiply it by the first year's PV factor. At first year end, with the new asset installed, its NPV begins from then. So take NPV of that day. The NPV for the first year end appears lower because you had already calculated it, and then from then, you'll effectively start receiving it. So apply the first year's PV factor to this as well, and you'll get the total NPV if you replace after 1 year. This is how the institute proceeds. Calculate total NPV if you replace today. That is the total NPV after 1 year and total NPV after 2 years. First year's cash flow from the existing asset will be multiplied by its PV factor. Then the existing asset's second year cash flow is multiplied by the second year's PV factor since replacement is after 2 years. At the second year end, sell the old asset, then get salvage value. By adding that, then multiply that by the second year PV factor. You know the new assets NPV is for year 2 end, so you can multiply it by the PV factor of year 2. This gives the total NPV. For third year, it's 3 years existing asset, salvage value and new NPV. If it's for 4 years, just continue calculating as per the provided data. In the third step, you should replace the asset and it will be in that scenario which has the highest total NPV. Well, we will replace it in the scenario where the total NPV is the absolute highest. Keep this in mind and memorize it. I have explained it logically. Many things might come to your mind, keep them away from your thoughts. I am explaining this from the perspective of 2 questions the institute uses, and practically many different even better methods are available. Then see next. We were discussing other decisions. I explained the replacement decision. Now selection of asset using equivalent annual cost. What is this? You go to the market and see 2 assets. So now to select one, what you would do is typically choose the one that is offering more benefit. It's not just the benefits, the real issue is differing useful lives. So the asset with longer life, we assume it gives more benefit. Let's assume that the production units, their sales and the associated inflows from using these assets will be the same. Select the one with the longer useful life. The one with the longer useful life also has a higher investment cost. Now question is, how should we decide? If we need to make a decision now, in such cases the equivalent annual cost method is used. Now you need to understand what equivalent annual cost is. Look, what do you do in such a case? Now let's consider the example I shared. Machine A has a 3-year life and machine B has a 2-year life. Both are available in the market. Look, these machines will ultimately provide identical inflows since sales and production metrics will be constant, integral to my business. Now to compare the machines, what you will have to do is compare them based on the machine's outflows. Basically, how much expense will the machine incur? Look at that. You need to judge the machine, right? The ultimate use of the machine will be the same. So to judge which machine it is, you can look at the machine's outflows. And what about machine's outflows? First, there's the initial investment. Then the machine runs annually, incurring running costs like operating, maintenance, repair and insurance cost. These you'll have. Okay, so whatever those costs are, you can consider them. When the machine's life ends and it's sold as scrap, the salvage value also needs consideration. Find out the machine's net cash outflow. What's its value? These outflows are solely for the machine itself, not connected to the project. Find these outflows for both machines because the initial investment occurs at a different time. As annual running costs occur at different points in time, you will need to find their PV to determine each machine's cash outflows. Consider the first machine's initial investment. Calculate the annual running cost PV and then sum it up for the total cost. After 3 years, when scrapped, its salvage value is received. Calculate its PV and as a benefit minus this. This gives machine A's PV cash outflow. Similarly for machine B. For example, the present value of the total cash outflow for machine A, that comes out to be 1 lakh. Machine A's PV cash outflow is 1 lakh while machine B's is 90,000. Which to take? How will we understand? You simply choose the one with lower PV of cash outflow. Machine B's useful life is shorter and the other machine has a longer one. So if the machine B's PV of cash outflow was 120,000, then it's clear that machine A's lower PV of cash outflow and longer useful life, so make the choice. However, this scenario creates issues. After calculating PV of cash outflow, you must perform one additional working, irrespective of the scenario. Now, calculate the equivalent annual cost. What is equivalent annual cost and how is it calculated? So it is very easy since you have already determined the PV of cash outflow. You have to divide it by the PVAF, meaning its useful life defines its usage period, divided by the PVAF calculated using its discounting rate and discounting factor. So in this case, if you divide 1 lakh by 2.487, it will be 40,200. For machine B, PV of cash outflow is 90,000 divided by the PVAF for its 2-year life at 10%. Divided by PVAF for 10% for 2 years and you get its equivalent annual cost. We will make decisions by comparing these. But what is this? How was it calculated? What did we do? So I'll explain a bit about that. So understand one thing. See, first you need to understand the meaning of this 1 lakh and 90,000. So look, what does rupees 1 lakh represent? The PV of cash outflow for machine A at 1 lakh signifies the machine's total expenses over its useful life. If seen in terms of present value, it's 1 lakh. Meaning if I spend 1 lakh on machinery today, then I don't have to spend anything on it for its entire life. This is the ultimate meaning of PV. Those who understood PV will get this. I can't do anything for those who didn't understand PV. It's a simple matter. Similarly for machine B, if I spend 90,000 on it today, I won't have to spend anything on it for its entire life. This much fact should be clear to you. Now look further. So this is its meaning that we have. So now I want to find out. Here, my decision making involves assets with distinct useful lives. I want to determine each machine's annual expense, like installments. The 1 lakh that's on any machine is spent today covering all its lifetime expenses. So instead of spending 1 lakh on the machine today, I would have to spend it annually. If I had to incur expenses on the machine annually and not spend anything today, just pay an annual installment, then tell me what would be the amount of that installment. Just like calculating the loan installments, it's completely normal. Instead of paying this 1 lakh upfront today, I would pay at the end of the first, second, and third year, throughout its 3-year useful life. If I were to pay an installment for the machine's expenses, what would that amount be? Can you calculate that once? So look, if the amount is 1 lakh, what should this annual installment and the annual cash inflow be? What should the annual cash inflow be? Like if I need a 1 lakh cash inflow in present value terms, what would it be? If I multiply the cash inflow by the PVAF at a 10% discount rate for 3 years, wouldn't I then find out the cash inflow installment? So it's the same thing. Here the 1 lakh cash outflow, if it didn't happen today but at the end of each year, then what would be the equivalent annual cost amount? Should I incur 1 lakh rupees today? This means nothing more is needed after this, because this amount represents the entire machine's total incorporated cost, the P&L of all cash outflows. So this is how we determine the annually equivalent cost, which calculates to 40,200. Nothing else done, just PV applied. The same came for machine B as 51873. You are going to spend 40,209 rupees every year on the machine. Besides this, I have no initial investment or any other expense. If I say that for machine A, I will incur an expense of 40,209 every year for 3 years. Or let's say if the machine incurs 1 lakh expense at time 0. Or consider machine A's initial investment with annual running cost incurred on specific dates and the salvage value received later. All the three mean the same thing for decision making. Now look here. Now decision making will become easier for you, because here you figured out that if you use machine A for its entire life, the machine will incur a cost of 40,209 every single year. Just assume this. This includes the cost of operation, the running cost, maintenance cost, and the owning cost. Also initial investment and everything is included. And machine B's annual cost is 51873. Machine A is better, so we should select this one. I hope you have understood. Let me tell you, this is not an actual expense on the machine. We have calculated this only for the decision making. Actually, annual running costs are incurred and the initial investment is made today. But all that specific data had indeed been widely spread out, and then I simply took that scattered information and derived a very clear figure for what the annual expense would actually be. That will give a similar value for decision making. So I first calculated the PV of the total annual expense, which gave the total expense at time 0. Then distributed time 0 expense into annual equivalent amount. And if I say annually 40,209 is spent on machine for 3 years. So it's simple meaning, overall at time 0, 1 lakh rupees is spent on the machine. Its simple meaning is that the initial investment, yearly running costs, and salvage value received from the machine all signify the same thing. Hope you understood, and if not, it's an easy exam topic to remember. What does the equivalent annual cost of an asset represent? It is the annual cost of owning, operating, and maintaining an asset over its useful life, accounting for every expense you are going to incur on it. It distributes that annually. You'll select the asset which has the lowest equivalent annual cost. It is calculated by taking the PV of cash outflows of the asset, then dividing it by PVAF. How is an asset's cash outflow PV calculated? Initial investment, that is purchase cost, plus PV of annual running costs for the asset like repair, maintenance, operating, or insurance costs, minus PV of asset salvage value, which might be in question as its resale or scrap value. Understood? This is complete for you. This topic isn't course syllabus we covered, it's only for one question. However, for ESE calculation, right? This syllabus part becomes useful. So we've studied it for this reason, and we also did one question related to it in class. Let's discuss the optimum replacement policy. In other decisions, I taught replacement decisions. We taught asset selection using ESE. Next we address optimum replacement cycle. Then this part is complete. This is the last decision in other decisions. Finding the optimum replacement cycle. What is this optimum replacement cycle? Understand that you'll get it very easily. There's nothing too special about it. Now look. What is this optimum replacement cycle? Optimum replacement cycle. This determination needs to be done for businesses with an unlimited operational life, where projects can be repeated again and again. But the assets that are involved in such businesses will always need to undergo continuous replacement. I hope you have understood. Means you'll understand with the example I gave you in class. For example, my business operates as a taxi service, meaning I consistently purchase new taxis to manage its operations. And then we have them. I provide them like cabs, Meaning if people need cab services, I provide that. So I have my taxis and through them I offer cab services to people. People book cabs, the cab goes, they make the payment and the cab drops them at their destination. You understand, normally it's my cab business. Alright, people can hire taxis from me. I buy cabs and I constantly acquire new taxis. So my business asset, what is it? It's a taxi. So the taxi, you see, it has a useful life. It's simple, it's a car. A car has a useful life. For example, here my example now will assume this. My car's useful life is 3 years. Any taxi I buy cannot run for more than 3 years. So after these 3 long years, my taxi simply goes to the junkyard. After this, I'll have to buy a new taxi, then I'll run it. Again, I'll buy a new taxi after 3 years. Meaning, my business isn't like when I sell a taxi, that's it. The business won't actually end with the asset's life. I can run the business for as long as I want. Meaning, my project can be repeated any number of times. It's just that with my asset, I will always have to keep replacing it. My business involves projects that can be repeated multiple times, allowing it to run for a very long period, and your assets will therefore require continuous replacement. Therefore, if you have a need for the continuous replacement of your asset, then when will you have to replace your asset? How much time should you take to replace your asset? Meaning, what should be the optimum replacement cycle for your asset? You figure that out. What exactly do you want to find out? You want to find out that how often I should replace the taxis in my business. Does 3-year life mean replacement then? I might replace it in 3 years, but listen to me. If I buy a taxi today, it will run well, but as it gets older, what will happen is its efficiency will definitely drop. It will start giving less mileage, operating cost will increase. The maintenance and service cost increase with asset age, like if the initial costs are lower. Service costs increase for the second year, and similarly, insurance costs also rise in the second year and higher in the third. And along with that, the salvage value will also keep decreasing. The older it gets, its selling price in the scrap market will also keep falling. It's a simple fact, and that's how the world works. It makes sense. So can you tell, should I replace the taxi only after 3 years when its useful life concludes? Or should I replace it every 2 years, or can it be simply every year? That is, I want to determine for my asset whether I should replace it every year, every 2 years, or every 3 years. After 3 years, I'll have to, as my asset is like that. If my asset's useful life is 5 years, should I replace it every 1 year, 2 years, 3, 4, or 5 years? Understood? You must have understood what I want to say. Meaning, I want to determine the optimum replacement cycle for my asset. For the asset I use in my business, what should its optimum replacement cycle be? Because that asset will be replaced, that's confirmed. It will definitely be replaced, but after how much time should I replace it to get the optimum benefit? Meaning, in which case is the cost lowest? Should I use the asset for 3 years then replace it? Should it be used for 2 years then replaced? I found this beneficial as the costs are lower in that scenario. So then what should I do is replace the taxi every 2 years. Replace it every 2 years despite the remaining life. This is the optimum replacement cycle that we have here, and you must have understood this very easy topic, which lets you easily score marks. As soon as I teach this topic, some people get confused. Do you know what they link this topic with? Some people mix this topic with when to replace the existing asset. You know, we have just discussed this. Should the asset be replaced today or after 1 year, 2 years, 3 or even 4 years? What is the difference between them? The difference is very subtle if you've grasped the concept. The previous topic discussed an existing asset that I have today. I was talking about replacing this one. Should I replace it today, after 1 year, 2 years or 3 years? When should I replace this? Then the new asset will run for 8 years as in our example, so that 8-year asset will come. Then we'll later see when to replace that. We were not discussing a repeated replacement cycle there. And for this decision, the optimum replacement cycle, what are we doing here? Our business needs assets replaced. We wish to ascertain the optimal asset replacement cycle for our business. We are not discussing replacing an existing asset today. Like if I purchase a taxi, then how frequently should I keep replacing it from time to time? And how often precisely should I replace it? This is what I want to determine to minimize cost. I hope you've understood the difference between the two topics. Here there's no talk of replace now at all. There's no existing asset. I can determine the optimum replacement cycle, where the asset requires continuous replacement. I just explained the first point. Next, how do we find the optimum replacement cycle? So for the optimum replacement cycle, you can use the assets EAC. You will determine it by calculating that. Calculating equivalent annual cost involves 2 easy steps. First, determine the assets EAC across the scenarios. Various scenarios. If I use the asset for only 1 year and then at that point I replace it, what will be EAC, which is the equivalent annual cost? Then what annual cost you will observe in equivalent terms in this? So in this case, if I look, it is the initial investment, 1 year's cash inflow outflow. salvage value at the end of the first year. Alright, you have completed the assets 1 year cash outflow NPV, and dividing it by the PVF for 1 year will be the same. So you will then understand that if you use the asset for 1 year, this cost will be incurred annually. Meaning if you replace the asset every year. EAC of the asset, if I use the asset for 2 years, initial investment plus the 2 years running cost and the salvage value at the end of second year. Okay, so PV of cash outflow divided by 2 years PV. This will tell you what your annual running, that is what your equivalent annual cost will be. If you replace the taxi every 2 years, then this will be your annual expense. For the 3 years use, the EAC will be, meaning 3 years of running cost, salvage value at the end of the third year, and initial investment. Calculated the PV of all these divided by the 3 years PVF since it's for 3 years. So what is the equivalent annual cost each year and what will be my expense annually? This applies for 4, 5 or any other relevant years. You'll keep doing it, understood? So in whichever case you find the EAC is lowest, meaning in the case where I see that the equivalent annual cost is less or it is lower, that specific scenario is for you. You see, this will be the optimum replacement cycle. For example, replacing the taxi in 1 year means the EAC becomes 40,000. For 2 years, EAC is 35,000 and for 3, 39,000. EAC means this expense will be incurred every year. Replacing the asset every 2 years means your annual expense is 35,000. So this is the best, isn't it? You should replace the taxi every 2 years. Understood? Here, look, I'll tell you one point. There's an assumption. Whenever we make any decisions in FM, there's always a theory involved. And behind every theory, there are some assumptions. No theory can exist without assumptions. So remember, no calculation happens without assumptions. This also has an assumption for those who overthink. You'll say that you'll buy the taxi again after 2 years. This again involves annual running cost, 2 years salvage value, and selling it after 2 years as previously explained. So perhaps we have made this assumption here. We assume that after 2 years the taxi's price, annual running costs and salvage value will remain the same. This is not our mission here. We cannot assume that the prices or the annual operating costs will increase after 2 years and then increase again after 4 years. If inflation exists, it affects all the scenarios, and considering it would hinder all the decision making. Therefore, we assume a normal scenario. Present cost including annual running expenses will remain unchanged in the future. Under the new tax regime, this applies for the first, second and third year. You will understand. This point is complete. Let me clarify one more thing here. We take the PV of cash outflow in EAC. The inflows that we get from using the taxi for the project are not relevant to our calculation, so we do not consider them. The revenue won't decrease with an older taxi, nothing like that occurs. Have you ever truly considered this a specific point when you call a cab? When you book online, you must have pointed out an old cab in which you won't wish to travel. If any of you students have actually done something like this, then you are a very special person to do something different like this. I haven't done it to date, and as far as I can say, 95% of people probably never do this. The 5% I'm talking about, they must be some Ambanis or the ones who do such things. Other people generally don't care about what the cab is like or its condition. People book a cab and upon its arrival, they finally ride to their destination. We don't usually check if the cab is 1 year old. So then tell me here, is it like you refuse a cab simply because it is 2 or 3 years old? That doesn't happen. We have nothing to do with it. For us, the cab should just arrive. It should drop us at our destination. So such inflows are not relevant as project inflows are identical in every scenario. Project inflows are identical for 1, 2 or 3 years. So they are not considered. Decisions are based on EAC concluding optimum replacement cycle. The last part of this chapter, part 4, real options. The final part of chapter, real options. Look, now what are real options? Now what is this real options thing? Let me tell you its meaning and types first. And for this topic, it's important not to use your extra brain at all. If you overthink this, it will confuse you. You just need to follow my instructions because this topic has limited exam relevancy. And it used to be there before also. On this topic, a question might have appeared with difficulty maybe once in 15 to 20 years. And that too, I'm saying perhaps it came. If it comes, 3 or 4 questions will be repeated. Otherwise it won't. And there is no need to overthink this, just listen and follow my instructions. We discussed this more in class and won't elaborate on it here. Its exam relevance is very low, so let me tell you what it is. Now look what real options are. Real options, you see, are an approach, a technique for capital budgeting decisions. I have to make a capital budgeting decision and, for example, an investment decision for a project. So it's a technique for that. If it's that technique, why not explain it first? The 5 techniques I mentioned at the start, it's like that, but this is a slightly special type of technique you'll understand soon. This technique applies to capital budgeting decisions for evaluating projects and making investment choices. Using the derivative chapter's option pricing concepts, meaning you have to make a capital budgeting decision, evaluate projects and make capital budgeting decisions. So the formulas you're using, which ones are they? They're from the derivatives chapter's option pricing section, namely the binomial model with its risk neutral approach and the Black-Scholes model. Are you using these two formulas here? Meaning, what do you do in real options? It's a technique of capital budgeting itself. It's used in capital budgeting decision making, real options. This method is for capital budgeting decision making. Here you can apply the option pricing concepts from the derivatives chapter. This means calculating an option's fair premium or initial value using models like binomial and Black-Scholes, risk neutral in binomial. So these two approaches, these methods or formulas are what you can use. Using these two formulas from derivatives, you are going to make the decisions here. You call those real options. So you must understand the options in this context. The complete derivatives knowledge that you have gained will apply here, and if derivatives have not been studied, then this topic cannot be understood. Without the derivatives, this topic is useless for you, so study them first, only then will you understand it completely. The entirety of derivatives will apply as it is. So shall I tell you one thing? Some individuals are very smart, and what do they often say? They say the institute places this chapter at the beginning, so why teach it at the end? We will do it at the beginning according to our institute because we are smart, so look at the result of smartness. You won't be able to do this topic at all, okay? Only after derivatives is done, you can do this. So let me tell you here, the institute is even smarter, and the teachers in the market are also exceptionally brilliant. This was previously in institute's syllabus, part of capital budgeting. The institute has this topic now. This topic is placed in your derivatives section. My students already know this because I always explain this to them in class beforehand. Those students not studying from me do not watch YouTube content either. What do? The real options topic and its questions aren't found in the derivatives question bank and module. Highly disappointed, some special students write to me claiming they don't know how to create anything. I must give them what they actually need and then patiently explain everything to them. I must explain this to them differently, not by teaching, but revealing how special they are. Alright, so they don't want to verify anything. All they want is to find flaws, and they don't even want to match the things properly. So this topic, capital budgeting, I will teach it here itself. My teaching method isn't to just dump things wherever they are placed. Like other people compile, many times they compile everything like illustrations, test your knowledge and give it to you. Many consider compilation effortless. That applies to some teachers, but not me. Arranging topics sequentially takes a lot of effort despite seeming easy. In this, if the institute has ever changed anything in an RTP exam, updated something or corrected an answer that was wrong. After that, the topic is placed in the chapter it belongs to. Just like real options is a topic here, it's a capital budgeting technique, not a derivatives topic, as only the derivatives formula is used. Derivative formulas are used, but this isn't a derivatives topic as no actual option contracts exist. Real options is its name, but don't assume I'm doing an option contract. There is no actual option contract. You are only using the two models from derivatives here, two formulas. So therefore, I won't consider real options a derivatives topic. A capital budgeting technique, just the same like we use those mathematical formulas. Alright, like I use the statistics formulas to calculate NPV, ENPV, standard deviation. To calculate standard deviation and project NPV. Therefore, I will not explicitly state that the project's expected net present value and its standard deviation, because you must have already studied these concepts in statistics at the school level. Statistics isn't a distinct syllabus topic, its concepts are studied within relevant chapters. Real options use the derivative formulas, but it's a capital budgeting technique. Most people, even the teachers, don't realize this, and I guarantee many teach it unaware. No one will explain these details, they just solve questions without thorough explanation. This is a guarantee. They do not know it themselves, just assigning questions. Students don't realize they get excited when the questions are solved and it seems easy. So that is the case. Real options is a topic taught here, and we will solve its questions here. Likewise, other relevant topics are included in their respective chapters. Those who have not studied live from me, those who only watch the revision video and are about to make assumptions, then listen first. Or otherwise you'll get fitting replies. Then you'll feel that I am like this, how could I say such things? Then they also get offended that how could I give such a reply? Therefore, you will get the reply politely depending on how you ask the question. And if you ask absurd questions, you'll get absurd replies. So now look all of you. Real options is a decision-making technique for capital budgeting. In capital budgeting, you evaluate projects to decide. The only difference is you apply two models from the derivatives chapter for option pricing. Hence, they are real options. Apart from this, don't assume we're creating an option contract for the project. There is no actual contract which is involved, nothing at all. You simply use two models, that is the Black-Scholes model and the binomial model. So I'll tell you one thing, and you need to understand that this technique is quite special, and that's why it is taught later. Otherwise, if I had taught it at the very beginning, you would have been confused right away. So it was moved to the very end. But is this technique really necessary? When making capital budgeting decisions, we must evaluate the project. If we have to decide whether to invest in this machine or not, we already have excellent methods like the NPV method. So why do we even need this real option method? And what's the need for this seemingly useless technique that has been included in the syllabus? Is this for the theory or is it used practically? It is also used practically. And this technique is necessary. This technique is needed for special decisions. See, when the technique itself is special, then it is definitely used for special decision making and special calculations. So you need to do special calculations or make special decisions related to the project. And that's when you use real options. If you're making a normal project decision, for example, whether to invest, use normal methods, as real options have no role. Real options come into play when you have to do special decision making. I need to know something special about the project. I will tell you what that special decision making will be. I need to know something special. For something special, special work and a specific formula are required which we get from derivatives. Now, when these were used, they were called real options. It's simple. Don't go into more detail here. Now look, let's talk further. In real options, I have written the same thing, that it's a capital budgeting decision making technique in which concepts of option pricing from derivatives are used. Look here. How are they used? If I link it a bit with option pricing, which we will study in detail now. The right to invest in a project at a certain future date. Now we specifically have to make a crucial decision here, where I have the full right to either invest in project today or invest in that after 1 year. I have the right to invest after 1 year, which is a simple matter, and so the right is not due to any contract. You might think this is an option contract. Suppose I have to invest in a machine. Should I invest today or 1 year from now? It's my choice. Has anyone forced me to invest today? It's my choice. I always have this right, and I don't need to make a contract with anyone. While exceptions exist, generally no contract is needed. No actual contract is made here in options. But if you think logically, it doesn't seem like that. Means I can invest in this project after 1 year. I have this right. Isn't this like a call option that I can buy this share after 1 year? I can buy this machine after 1 year, and it's the same idea. So the right to invest in project at a future date is like a call option. The second point is the right to dispose of or abandon a project later. For example, I invested in a project today. The project now invested has a 5-year useful life. After 1 year, what I'm thinking is of disposing this project. I have the right. I'm thinking I can sell it after 1 year because it's my wish and I haven't made any contract. But if I wish, I can sell it, right? Suppose I bought this machine. Having a 5-year useful life, I'll either run it or after a year, can I sell it to someone? Can anyone stop me, as I'm not tied down? Exceptions do exist, so don't consider those here. So these rights are not coming from any contract here. These already exist in projects. So I have the right to dispose of or abandon. Dispose of means to sell and abandon means to leave the project at a certain future date. The right to sell a project at a future date is like a put option. Let's check. So do you understand this point, that you have to use the topics from option contracts to perform these specific calculations, including the Black-Scholes? How will the binomial model be used for working? You will now understand the special decision making required. You can see that the real options usually have 3 types: timing, abandonment, and growth. We will now understand these, focusing on their exam importance. First, we will discuss the timing option. What is a timing option? It's very easy and simple to understand. You use timing options in specific situations. Now let's examine their usage. As mentioned, it's a capital budgeting decision technique used for project evaluation. But you'll have to make a special decision, not normal. Now let's see which decision uses the timing option. It is used to make this particular decision, specifically focusing as to when should I invest in a project. That is whether to accept the project now or wait for a future date, which means should I invest in this project today? Or should I do it after 1 year? For example, should I invest after 1 year or today? I have to make this decision. When to invest, you can say when should I invest in the project? This is a special decision, isn't it? So if you have to make a decision about when to invest in a project, you will have to use the timing option of real options. A timing option is a specific type. It is much like the call and put options, which we have seen in standard derivative contracts. You can simply understand it as such. So you will have to use this. Did you get it? So if you have to decide when to invest in a project, the timing option is used. Meaning, should I accept the project today or wait for some time, which could be 1 year later, 2 years later, whatever is given in our example. You can accept today or simply wait for 1 year. That's the scenario. How the timing option will be used, I'll explain it completely. It's very easy, and before explaining that, I'll clarify one more important thing. Some people have a habit of mixing topics, those who have incomplete knowledge. Or either they don't listen to the lectures with conceptual focus. When I discussed on topic when to invest in a project today or 1 year later. So they might have thought that, have I taught this? Yes, I have. What have I taught? Here it is. When to replace that? When to replace an asset. That concerned existing asset replacement. This differs here. We are not discussing replacement now. Now we are discussing a completely different point. It's about when to make a fresh investment in a project. Should investment be made today or after 1 year? This point must be absolutely clear. We are discussing a distinct topic, and calculations here use the real options, that is timing option. Now for the calculation, we have to make a decision now. It is simple. Invest in the project today. Then find out what NPV I will get, and if I invest in the project after 1 year, find out what NPV I can see according to today's value. Compare both, then the decision is made, that is working in 3 steps. First, what is the NPV if you invest in the project today? Second, if you invest after 1 year, what will be the NPV? Compare both, then make a decision, and this 3-step process should now be clear in your mind. For step 1, I'm calculating the NPV, considering if we wait until a future date. Step 1 needs explanation. You already understand step 2, so let's first look at what's happening there. The NPV of the project, if accepted now, is simply the PV of cash inflows initial investment. It means calculating the NPV taught at the beginning of this chapter. Step 3. Tell me, should I accept the project today or wait for future? In whichever case it is, whichever timing gives a higher NPV, you see that, is the NPV higher if I accept today, or is it higher if I wait for a year? Steps 2 and 3 are done. Step 1 requires derivatives application. Let's now understand how it will be applied and its specific method. What is being discussed here? We want to see this. With the timing option, we will check when to invest in the project. Will it be today or after 1 year like in our example? So in today's case, if it was about whether to accept the project today or not, then we would have calculated normal NPV. Real options would not have been necessary. Why is the real option topic needed? This is because whether to invest today or delay for 1 year, you will apply the timing option to calculate the net present value for that future investment. So what will you apply in the timing option? It is the single period binomial model. Now apply the binomial model to calculate the net present value for 1 year from now, as you will consider it like a call option. So why is it? As my right to invest 1 year from now is like a call option as just explained. I have the right to invest after 1 year if I want. I haven't signed a contract, this is my normal right. It's my choice, I can invest today or after a year, understood? So you have to revise the single period binomial model that was taught in derivatives, otherwise you won't understand. You will apply that to find the value of the timing option, you will certainly obtain that value. What is the value of timing option here? The value of a timing option is nothing. It means, what is the NPV? What is the NPV seen today if I accept the project after 1 year? What NPV would be visible if I wait for a future date? If you wait for some future date, what NPV is visible at time 0 in that case? So what NPV would be visible at time 0 if you wait for a future date? So you will get that, okay? You will get it. Now, I will explain to you how we will apply this binomial model. In this case, you have the NPV for today's acceptance, making the decision easy. Now, let's see how the binomial model will apply. I'll explain with the same example. Let's suppose I need to invest in a solar plant. Do you understand what it is? I want to install one in my factory. A solar plant means I have to invest in solar panels and other things, which means I won't have to buy electricity from the government. There the cost is suppose 10 rupees per unit. And I consume 2 lakh units annually every year. This means a 20 lakh rupees bill. But if I invest in a solar plant, I won't have to buy electricity. My electricity will be generated for free. So instead of an annual cash inflow, I will have annual savings. My cost will be saved, which means a 20 lakh rupees expense that will be saved, which is a cash inflow. Now in this case, the investment in the solar plant, let's say, is 1.5 crore. The annual cash inflow is 20 lakh rupees, and you should assume this saving will be received for project's entire life. Calculating lifelong cash flow PV means finding the cash inflow PV, then divide by 10% discounting rate, recalling our basics, as it was taught in FM basics. It's 2 crore PV of cash inflow. To calculate NPV, it's PV of cash inflow minus initial investment. This NPV is seen if you accept the project today of 0.5 crore. So in the when to accept scenario, I have completed step 2, which is very simple. Now considering step 1, if I wait for 1 year, what would happen if we waited for an year, and then why did this point come up? Then you will use the timing option and the binomial model to derive that value. So why should there be a wait for an year at all? So listen, now I will explain it to you with a reason so that you gain even more confidence in the topic. Take a look now. Look, what is the situation today? So today, if you invest in the project, you will get a 2 crore. I'm creating a decision tree in a way. At time 0, you would see a PV of cash inflow and you'll see 20 lakh annual savings. Now, if I start the project today, this is the PV of cash inflow. But as I was thinking, it occurred to me that there are elections a year from now. The results will be out. And 1 year from now, there are elections in the country. The results will come out and these two parties are the major ones in this. So what will happen is either of these two parties can come into power, and I observe these two parties directly. I observed that if this party wins, electricity prices will increase. From the current 10 rupees, they will make it 15 rupees per unit. This means my annual electricity cost will be 15 rupees into 2 lakh units, which is 30 lakhs if I don't install solar panels. My cost will be 30 lakh rupees every year, and present value of cash inflow is 30 lakh divided by 10%, giving 3 crore. Therefore, the present value of the cash inflow, which represents my benefit, is 3 crore. But what if the other political party should win? If this second party wins, means AAP party. The AAP party believes in distributing things for free. They believe in distributing the nation's treasury as taxpayers' money, but not for development. They care little, as their goal is to distribute freebies and gain power. So if such a party comes, then they will reduce the electricity price of 10 rupees per unit directly to 4 rupees per unit. It will be 2 lakh into 4. This means then my electricity cost will be 8 lakh rupees per annum. So if we look at PV, 8 lakh divided by 10% yields 80 lakh, which is the cash inflows present value. The total lifetime PV of cash inflows is seen as 80 lakhs. One political party desires to develop the country, so it needs funds and will naturally raise prices, as development requires government to have sufficient money. The other party, being freeloaders, distributes freebies and reduces electricity prices. Why overthink this matter? When investing in a project, why involve politics and other irrelevant factors? Think about it, as these are useful in practice. See, if this party wins, I will get a PV of cash inflow of 3 crore, which was currently looking like 2 crore. So it's beneficial for me. It's a good thing a higher PV of cash inflow is seen. More savings mean more profit, and I'll definitely think that this is a great project. Earlier I thought I would save only 20 lakh per annum. Now I will save 30 lakh per annum. That's great. Look at the net present value I'm getting. So let me correct. The present value of cash inflow is 3 crore minus 1.5 crore initial investment. So 1.5 crore in this case. But suppose this AAP party comes into power. These people are freeloaders. They want to give things for free. This party would cut the electricity prices. Then the electricity cost will be only 8 lakh rupees every year. So my PV of cash inflow will only be 80 lakhs. 80 lakh rupees implies that to gain a total benefit of 80 lakhs. Installing solar panel for 1.5 crore with a negative NPV would be foolish. Negative 70 lakhs. For a benefit of 80 lakh rupees by investing 1.5 crore in solar panels results in a 70 lakh negative NPV. Well, now you can see anything could potentially happen in the market after 1 year. These two scenarios could unfold after 1 year. And then the market scenario after 1 year will actually determine where your project is going to move. Your project's PV of cash inflow can change. If it becomes 3 crore, the NPV is then 1.5 crore if I invest after 1 year. And if after 1 year the PV of cash inflow seems to be 80 lakh, if that scenario happens in the market, if NPV is negative, I would not invest, hence it's 0. I would not invest, so it will be 0. Right? I simply will not invest. If I make the decision after 1 year, you need to apply the binomial model to calculate the timing options value, and then we will discuss how to do this. The binomial model also involved a tree structure. The underlying share's current price. What is the expected price of the underlying share if it rises at maturity, and what if it drops after 1 year? In that case, you would see what payoffs you would get. So here in a way you see the payoff is the NPV payoff. And now here, what inputs will you use for the binomial model? So you know, the underlying current price is the project's PV of cash inflows, and you will use the same formula with the capital budgeting data. Current underlying price is the project cash inflows PV. So at time 0, the current underlying price, the PV of cash inflows is 2 crore. Expected price of the underlying, the one that moves up, The expected higher underlying price is the PV of cash inflows from the project if invested on the higher side. The expected higher PV of cash inflows at the first year's end is the underlying, specifically the PV of cash inflows. And then present value of cash inflows of future date on the lower side. This is it. What will be the strike price? It will be the project's investment cost. In the future, after 1 year, my strike price at which I could exercise the share will be the investment amount, right? The project will be exercised on this. Understood? This is what I will invest. So your investment amount will act as strike price. So here you can calculate the payoff. In this, a benefit of 3 crore is visible. Your 1.5 crore is the strike price NPV of 1.5 crore. In the other case, the payoff will be a benefit of 80 lakhs. 1.5 crore investment yields negative NPV, so payoff is 0. The payoff can never be negative and will logically verify this point. In case of a call option, it is exercised if the market price is above the strike price, otherwise it is not. So look here, in a way, your market price is 3 crore. The strike price is 1.5 crore initial investment. So you exercise if the market price is higher and do not if it is lower. And if you think logically, why would you even exercise and incur a loss for yourself? It's because you choose to invest or not. So the payoff is 0. Now, the simple reason behind why the binomial model is being applied is that in the binomial model, what values you can get if certain scenarios happen in the future. They have probabilities, so take expected value and find its PV. We simply need to calculate the expected value at year end. But we need to bring their NPV to time 0, right? To compare it with today's value. This is also termed PV and hence only the binomial model's formula is applied. Apply the binomial model in step 1. You create a decision tree and you need probabilities. Look at the probability PV cash inflow being 3 crore or 80 lakh. What is the party's winning probability? Can I choose? If it's my choice, I'll assume a higher probability for the party I support. You'll proceed with risk neutral probability as this has been thoroughly explained in derivatives. Apply formula 1 plus RT minus D divided by U minus D. The probability of decrease is calculated as 1 minus P. D and U, everything has been explained. What is D? The move down price is the lower divided by today's spot price. U means the upper price divided by today's price. So which one is today's? Understood. 1 plus RT. R is interest rate and time in our example is 1 year. Third step is the payoff already calculated above. Then in the fourth step, calculate the option's expected maturity value by multiplying payoff with its probability. The total payoff, that is 1.5 crore, is achieved with the 0.9 probability and which is then assumed as risk neutral. Payoff is 0 with this probability. So did you total this? This is the expected net present value for the project's first year when investing after 1 year. You need to bring the NPV to time 0 for comparison by calculating its present value. How is this PV done? You simply apply 1 plus RT. So you are applying the binomial model's formula and with this the timing option is complete. You will get the NPV if you wait for a future date. Step 2 calculates today's project NPV as it was shown earlier. The case with the higher net present value is clearly the better choice for you. Now let's cover the abandonment option. It's easier after the timing option. What is this abandonment option actually used for and what's its purpose? It is used to calculate the extra value in a project due to the option of disposing of the project at a future date. I have the option in the project for it to dispose of at a future date. So in that case, it is used to calculate the extra value I can see in the project due to the disposing of option. Look, suppose I have already started a project. So where is this abandonment option used when you are already running a project? I'm already running a project. From this project, I expect the future inflows and to begin I must have estimated a positive NPV. But now I currently anticipate that by the first year's end, the economy might enter recession. Economy goes through recession. If the economy goes into the recession, then the cash flows I expected will be lower. The cash flows will be very low and I won't be able to recover my entire investment. PV of cash inflows will decrease. So in this case, I'm thinking if I sell the project and get out, if it's a machine, sell it and get out. Then is it beneficial for me? By this, it clearly means that if you have the option to dispose of, which is inbuilt and not through a contract. So in that case, if you sell the project and get out, it's beneficial. So because of that, you calculate what extra benefit is visible in the project. Let us now look at a practical example. It is treated like a put option because we are discussing the right to sell, as this gives us the option to sell the project. You'll use binomial model. All values are based on single period binomial model discussed in derivatives to calculate value of the abandonment option. Its value isn't NPV. What does value of this option give? What extra value do you see in the project due to the option of disposing of it? Suppose the project didn't have this choice. Suppose that I could not sell it and get out in between. If there was such a restriction, some condition, suppose I couldn't sell and get out. If the economy enters recession, you'd still have to run the project and the cash inflows PV would drop, making the NPV negative. Understood? So here also we must apply the binomial model's inputs. Current underlying price is the project's cash inflow PV and the strike price is its sale price. Expected price move up. The PV of cash inflows on the higher side are visible and on the lower side. And time means the future disposal date of the project. Let's see an example. Project investment is 1.5 crore. At time 0, a PV of cash inflow of 2 crore was visible and I have already made this investment. Now at the end of the first year, after investing, I feel that at the first year end, 3 crore. A 3 crore PV of cash inflow is also a possibility for me. Why is this possible? Because the economy can grow, or if the economy goes into the recession, then a PV of cash inflow of 1 crore rupees is expected. So look here, what will be your decision making now? Here the decision making will be, if present value of cash inflow is 3 crore, it is beneficial because I had only expected 2 crore and it now raises my net present value without loss. Look, there is a PV of cash inflow of 3 crore which is visible. I have an investment of 1.5 crore. So I don't need to make a sale decision here, so the payoff is 0. Okay? But if a PV of cash inflow of 1 crore is visible, so as it's a PV of cash inflow of 1 crore and I have made an investment of 1.5 crore, so I'm going into a loss. In this case, I will think of selling it. So suppose the selling price is 1.2 crore and the project can be sold or transferred. Its value is 1.2 crore. Therefore, that project whose future benefits PV is seen as 1 crore rupees. So just sell in the market for 1.2 crore, it will be great. If I run it, I'll earn 1 crore and if I sell it, I'll get 1.2 crore. So there's an extra benefit of 0.2 crore. And if the PV of cash inflow is 3 crore, would you want to sell it for 1.2 crore? No. Why would I sell it for 1.2 crore when I can earn 3 crore by running it? I definitely won't be selling that, so the payoff here would be 0. Same like a put option with a strike price of 1.2 crore, you can sell if market price is lower, otherwise you don't. Here, the market price is higher than the strike price, so you would not sell. And here, with market price lower than the 1.2 crore strike, selling is clearly beneficial. Did you get it? So this is all I had to explain. This future benefit is an extra one that is due to the disposing of option. You have to do its probability weighted PV, meaning binomial model. The same thing will be applied, this probability. Probability weighted, that is to calculate the expected value. So you divide by 1 plus RT to find the PV, and this abandonment option is quite simple. Look at the last option. What are growth options? Growth options fall into a more special category of real options. Take a look at this. Look what is in growth option. Growth option. They are used to calculate the value of intangible assets like patents. Growth options are used to find the value of your intangible assets. So here, it's not about decision making in a project. Here we want to find the value of intangible assets. Look, I said real options are for special calculations, special decision making for a special purpose. So if you want to value an intangible asset like a patent, then the growth option is used. Why? Because the NPV of an intangible asset is in a way insignificant, you can't figure it out. You cannot calculate it as you don't see anything. But they provide growth to the business in the future. They give growth to the business in the future. For example, you all should understand. I gave you an example. For example, like a patent, it gives you a lot of benefit. But if you try to calculate its net present value, then you will see it as almost negligible. Because their value is calculated specially, intangible assets are valued using the growth option. Let's quickly understand how it works. Alright, let's understand. What is a patent? For example, suppose I am a pharmaceutical manufacturing company and I make drugs or medicines. The word drugs doesn't just mean substances that cause addiction. If you overdose on any medicine, you'll either get high or leave this world. So drugs mean medicines that I make. I'm a medicine manufacturing company, okay? A drugs manufacturing company. So I'm willing to make a medicine that can cure cancer. A medicine that can cure cancer in a proper way, I want to make such a medicine. So for that, first of all, what would I be needing is to get the research done. Ultimately, I need to find a formula for this medicine that can cure cancer. Then I can develop the medicine and invest project funds. But first, it is very crucial that I get the required research done. Like when you have a fever, you usually take paracetamol for relief. And paracetamol comes in many variants like 350 mg, 500 mg, 650 mg. So what is paracetamol? It's a formula for a medicine. That formula was first discovered by one person. He did the research. He worked hard. After that, the whole world came to know. They copied it, put their brand name on it. Dolo 650, Calpol, I don't know what all names. So anyone can do that, but it truly takes significant effort just once. A single individual must perform the initial rigorous research to discover that specific formula. Once that formula has been known, then the cancer medicine can be easily made. But now if I have done this, found the formula for cancer and made the medicine, then the whole world will also make it. The whole world will also make this medicine. Everyone will know the formula then. What extra benefit did I get from my hard work? If suppose I found the formula and made the medicine from it, then all the benefit comes to me and I earn a good profit. But all companies will start making the medicine. Like what happened with paracetamol, the whole world got to know. As soon as paracetamol 500 mg was released as a medicine, it cured fever, so all companies copied the formula. The person who first made the calculator must have done extensive research. Later on, you'll find calculators from every local company. What do they have to do? Nothing. They saw how the same calculator was made. They copied it exactly and stuck their own brand on it. Later on, there's nothing. It's just the initial hard work. So for that, you have intangible assets. So for that, you have to get a patent. So let's say, suppose I did research. And through my thorough research, I have found out a specific formula. Suppose, for instance, I found a formula called Consiterius 500 milligrams from my research. This formula enables cancer medicine. Currently, only I know it from research and the medicine is not yet made. So now I want to get the full benefit. I got it patented. Suppose this patent is for 15 years. This means for 15 years, unless I give the right to someone, no one else can make this medicine. Even though the whole world will know that this medicine exists, still no one will be able to make it. Now I will charge whatever rate I want and make a huge profit. Understood? So if companies want to do this, pharma companies do get patents. They do it in reality as well, if they want to make a profit. However, for the societal good, they make these open, because medicine is a very important thing. Like during the corona pandemic, the formula for the vaccine that was made, it was made open for every single person. Like in India, many were made, like Covaxin, Covishield, Russia's Sputnik, US's Pfizer companies, as it was made open there. Even if it was patented, it was an open right one, so everyone was using it. It depends on what your motive is and also what it is not. This is a simple concept. Intangible assets such as patents provide benefits and you gain advantages in this manner. Now you can look at this. A patent is just a piece of paper, essentially. It describes the Consiterius 500 milligram, then granting the company exclusive rights that was for 15 years. No one else can actually develop it. A case will be filed if it's violated, leading to compensation and jail. It's a simple thing and these are very strict rules. So I have this certificate, I have the patent for it. No one can do anything. This patent as an intangible asset is valuable for you. Now you can calculate this patent's NPV and what is its value. So what will its value be? Let's say the cost of registering the patent was 1000 rupees. I had to fill a form with the government. Look, the cost is this much, not very high. Record this 1000 rupees patent in books. A patent of 1000 rupees, is it possible? With which I will make a cancer drug and earn crores in profit. The patent for that is only for 1000 rupees. That's wrong, right? Absolutely wrong. The patent, this intangible asset, its NPV cannot be determined directly like this. For them, what do you have to do? A different model is necessary because these assets provide significant business growth. With this patent, I can develop this medicine and exclusively profit, as no one else will be able to. The patent's value is quite good and we need to find that. For this, the growth option is used and you should have understood it. Now this growth option is treated like a call option. Here you'll apply the Black-Scholes model to find the value of the intangible asset. Until now we have used the binomial model. For the growth model, Black-Scholes applies. The Black-Scholes model was useless there and it is useless here too. This topic lacks exam relevance. This part is even more irrelevant as the Black-Scholes model is applied here and its presence makes topics irrelevant. But look, it's easy. It's nothing, just a formula, so I'll quickly explain it once. Let's discuss the patent. So why wasn't Black-Scholes applied here and why was it considered a call option? I'll briefly explain without much detail. A patent is just piece of paper. But this piece of paper has value. What is it? So because of this, I'll be able to get my medicine developed. That is, now I'll be able to invest money in the cancer drug project. Once the formula is known, I'll invest and the cash inflows will come. Meaning I'll be able to invest in the project because of this patent. In a way, the project itself serves as the patent's underlying asset. There's no such thing, it's not like there's a contract that a contract has been made with someone for the underlying. A patent is not such a contract. Briefly grasping derivative concepts will clarify why the Black-Scholes model applies here and is treated as a call option. So a patent is a contract in a way, right? That is where I got the right to invest in this project. So that I can earn benefits, I'll be able to take benefit and no one else will, only because of this piece of paper, the patent. This is a call option providing the right to invest in the project. Understand the call option and why Black-Scholes was applied. Because look this patent here, what will be its expected price? You cannot even predict the expected price of a patent. When you cannot predict the expected price of something, you have to apply the Black-Scholes model. I told you this in the regular class on derivatives. We use the Black-Scholes model to calculate the value of the growth option for intangible assets. Its value is derived from it. The Black-Scholes model formula from the derivatives chapter is the exact same. Find current underlying price PV dividing by E to dt. Multiply by ND1, subtract strike price of PV divided by I to power RT into ND2. It's same formula with one change. We studied same formula derivatives chapter. We omit current underlying price PV. This wasn't done in the derivatives chapter. Here we are doing one extra step. I'll explain a bit about why we are doing this. Remember, it is the same Black-Scholes formula from the derivatives chapter with the current underlying price being the only difference. Its PV is also calculated by dividing by e to the power of dt. Why this division? PV requires compounding factor in denominator as Black-Scholes assumes continuous compounding. We calculate PV using e to the power of dt, and for the strike price, we use e to the power of RT, just as in derivatives. Was e to the power of dt written by mistake? No, it is completely correct. I will explain some of the reasons for this shortly. For now, let us move forward and see. The current underlying price here is the project's PV of cash inflows. And the strike price, as explained, it's the project's investment amount or development cost. Project investment for medicine development is its cost. PV of generated cash inflows is the underlying current price. R is the same annual interest rate. Time the intangible asset's life in years. A 15-year patent provides benefits only for its duration. I'll explain D later, hold that for now. After this, look at D1. What is this ND1? First, D1 is a Z-score. ND1 is the cumulative area for that D1 Z-score, which you find in a standard normal distribution table. First, find the D1 Z-score. Z-score uses the same derivatives formula, natural log of current underlying price divided by strike price. Plus or minus D, then add half variance times T and divide by the standard deviation of root T. Then D2 is D1 standard deviation times root T, and this is the same formula as in the derivatives chapter. Next, variance is the square of the standard deviation, and this refers to the variability of the project's PV of cash inflows. There can be a variance. How much is the variance? The variance in the PV of cash inflows. All the data remains identical. You are using capital budgeting data and the formula is the same. I will discuss two formula changes. I mentioned one change earlier. There is another one if you noticed where D is subtracting with R. In the derivatives chapter's Black-Scholes model, this was absent. It was just R plus half of variance. D is subtracted from R. These are the two changes. What is the reason? Let me explain. It's nothing but the dividend yield. Dividend yield relates to stocks and shares and was present in the derivatives model. Now it makes sense for shares. But what shares are we talking about? Here, we are talking about the project's dividend yield, which means the project's return. D is also called the expected cost of delay. To calculate D, divide 1 by the intangible assets life, as in 1 divided by 15 for a 15-year life, e to the power of dt. You calculate the PV using that, and here you are applying R minus D, which will solve your exam question. Now, why are we doing this? How was D derived? Let me explain a bit. See, the working is very detailed. I'll briefly cover the concept and full details are in the lecture, where these concepts are explained in more detail. Now look here. See, what is D? If you are going to earn as income from the project in a way, what is the income from the project? Project's cash inflows are given. So let's see how you will earn that income. For a moment, let's assume you are going to earn a return of only 1 rupee over entire 15 years of project. If the life is 15 years, then the earning will take 15 years. In percentage, by multiplying it by 100, you can earn 6.67% annually. For now, let us assume an equal annual return will come from the project. So for a 1 rupee return over 15 years, it means I will earn a 6.67% return each year. We should directly use decimals. 100 was for explanation only. In Black-Scholes model, we have to take data in decimals. You should not calculate in percentages but use decimals. It will be 0.0667. This provides the value of D for the formula, and this represents one logic for it. What is the other perspective? This is also called the expected cost of delay. Why is it called that? Expected cost of delay. Now look, the expected cost of delay is also based on an assumption. I have the patent today and its value must be calculated now, yet project investment occurs later. Project will generate cash inflows. So the return from my project is delayed. I have to calculate the patent value today, but the project's return will be received over a period of 15 years. My return is being delayed. By how much percent is it delayed each year? By 6.67%. It's delay in return every year. The return received annually makes up this delay. The return is getting delayed by 6.67%. You are receiving the return in parts every year. You can also understand this topic from this perspective. It is called expected cost of delay. Why calculate the PV of the current underlying price using e to the power of dt? Remember, the current underlying price was the PV of cash inflows. The cash inflows over a period, their PV was taken. But this is already PV. Yes, but it will be discounted again because now you are calculating the value of the patent, not the project. You are calculating the patent's value today, while these cash inflows are spread over 15 years, which means there is a delay in your project. A delay which is of 6.67% each year. Your return is being delayed. So you will discount it again because of that. Did you get it? That PV of the cash inflow was for the normal project. This patent calculation differs from the normal project's PV. What is next? Why we subtract D from R? It is for same reason dividend yield. As I explained, subtract this yield from R whenever it's present. This represents return. So remove this return from interest rate. I've explained this concept. With this, the topic is complete. I have also fully explained the growth option to you. This topic isn't too important for exams, so we'll be brief. Just go through it once, it is not a major topic. With that, I have revised all the concepts of the capital budgeting chapter for you in the detail. I have already solved the questions in the class for all the students of the regular batch. We discussed things in more detail there. However, for revision, I have explained it in detail. So, take the solutions of the questions solved in class with you. And refer, this will help you revise entire chapter even better. You won't get stuck anywhere, it's very easy chapter. For students who are directly watching the revision video, I have told you before, you guys should read the notes after listening to this. After reading notes, solve question bank problems using my steps and then match answers. Your answer will match. If doubts are remaining, then send them. Don't ask for the class solution. It is never shared and it will never be provided. Secondly, some students, particularly those not from my classes, are not diligent and watch the revision video. After that, they go directly to the question bank and look at the solution. Sir, this is done differently. You taught it differently. I don't understand. I mean, I have said this many times and still they do this. If you just want to watch my revision videos and not the class, and you have watched someone else's videos and studied from there, that's fine. But when you are watching my revision video, then first solve it yourself using these steps. Then if you get stuck or have a doubt, send me the solution you did yourself, the one with my steps, and then tell me, sir, my answer is not matching here. Then send it. If you directly send me that, sir, you taught this in the revision video, but in the question bank, the solution is like this. You taught it in a different way. What is this? We don't understand at all. Then you should watch the class directly. Then nothing, you are not able to work hard. So I make them write the solutions in class, practice there. Then this approach is truly not for you, my friends. You will have to work extremely hard. You are the one who has to do the hard work. It's your exam, not mine, right? Hard work alone brings results and understanding, and without it you will never gain confidence. For a moment, I will do one thing and then I will just show you this from the question bank. Look, I will also tell you about the questions. I will directly show you some of the special points in some questions. This is a question on the APV method. This is very easy and simple base NPV. And look, in this question, the post-tax cost of the debt is given. The tax rate is given, converted to pre-tax, resulting in 8%. Just remember that you must use this pre-tax rate. And for debt, you only have to take the tax shield on interest and nothing else, and you have to ignore everything else. This question, this is your normal inflation. I create topic-wise headings, as you know. The topics are arranged in the same sequence as I teach. The questions are arranged from easy to hard. So it's going like that. This was a normal question. I'll tell you the ones with special points. Now if you look at this question in the revenue, the costs inflation rate is given for each year and you will calculate the inflated values using these respective rates. If I will show you the solution that I had taught you. What do? You apply inflation to each year's revenue and to its corresponding cost, then calculate the values for revenue cost. Then you have to deduct depreciation. There was no inflation in depreciation because there was depreciation in the asset. So inflation had no impact on that. Then you'll get the cash inflow from tax and depreciation. Then you'll do the rest with the normal working. I had explained it. One question at a time. After this is your normal question, the RADR one. In the RADR, this company, to improve the question, RADR used coefficient of variation. For this project, coefficient of variation is 1.2, RADR is 16%. With its value at 0.8, the RADR is 14%. Simply use these rates for the projects and do evaluation. In this question, minimum required return is given, the risk-free rate is given, you have to find the RADR. So you will find it as I have shown. I have done the calculation for you all. For each project, we have RF plus risk premium. How is the risk premium calculated? Minimum required return minus RF into risk index. We calculated RADR, then we moved to NPV. The project concludes. Let's discuss another point now. Tax rate. Not everything provided to you will be useful in the question. Here, the inflows are given. These cash inflows come after adjusting everything, including tax. This has no role in question, it's just there so that you make mistake in it. And here, EBIT is not given so that you would not first deduct tax from it. Inflows are given directly. So keep this in mind. Don't make such mistakes. All this is fine. Certainty equivalent questions are simple. There's nothing in them. Regarding this utility approach, a specific utility value is provided for each type of cash flow. So cash flow, utility, probability into utility, expected value of utility. Sensitivity analysis. It's easy. Just have to do the calculation. Let's now consider the scenario where NPV becomes 0. In this case, look how do we do it. In these cases, you have to form an equation and I will show you the equation once. See, in this case, you first calculate the normal NPV. So I calculated your NPV in the normal scenario. It was 310293. Then in each case, first unit selling price. Look here. What should it be so that NPV becomes 0? You had to determine the sales price per unit. So let us see. The annual sales volume is given and constant. So assume the sales price per unit as X to derive the sales value. X times units. Minus variable cost cash flow. You calculate the PV now. Calculations in the terms of X require strong mathematical skills. This is the PV of cash inflows, from which you subtract the initial investment. Make it equal to 0. You will get what the selling price should be, the percentage change. Similarly, for unit cost, we assumed the variable cost per unit to be X. After this, sales volume was asked and then assumed as X. Special point is sales volume for first year is 20,000. For the second and third years, it is 30,000. X cannot be uniform annually. Assume that the first year sales volume is X. The second years will change proportionately. How much proportionately? 30,000 was how many times of 20,000? 1.5 times. So assume the second year's units to be 15X. This was the special point. I have calculated the sales volume for all 3 years. After this sales variable cost, the rest is the same equation. Here, initial outlay is assumed to be 0 and this is a very easy case. Then project life. What should be the change in project life so that your NPV becomes 0? In this, you will have to calculate in a special way. Project life of 1 year. In this question, a project life of 3 years was given and cash flows for these 3 years were provided. So in a 3-year project life, to make the project's NPV 0, how much should we reduce its life? This is a simple concept you understand. We then checked the cash flow assuming a 2-year project life. We checked the NPV for 2 years and it turned out negative. This implies it runs between 2 and 3 years and requires interpolation. In the case of 2 years, NPV is this. For 3 years, we have already calculated the NPV and it is somewhere in between. Interpolation is a mathematical method and I had already given its formula at the beginning during security valuation. What happens in the formula now? Lower rate, that is 2 years. Value on it -1. Minus required value, the needed NPV is 0. Then you must divide by your value at the lower rate. Minus value at a higher rate 310293. Into higher rate 3 years minus lower 2 years. If you do this, you will get 2.311 on solving, which is your project's life. If it is 2.311, the project's NPV will be 0. I had told you another alternative, the second method. You can see that I'm just telling you little bit. After this, questions. This question was a bit special, a good question. In this, they involved a topic from intermarginal costing. You needed to understand that. I'll explain this question on the project's initial investment. You have been told the project's IRR. A 5-year life was mentioned with this data provided. And now you are asked to find the initial investment. Find the initial investment of the project. And annual cash inflow is being mentioned. So if you PV annual cash inflow with IRR, what does it equal to? It equals initial investment. That's it. So first thing was this. This question required thought on the given data and the IRR was useful. Here is your initial investment. The second question, what is the project's NPV? So you got the initial investment. You need annual cash inflow at the discounting rate, the required return, not IRR. How is it obtained? The sensitivity of the discount rate is provided as 60%. And that too in the case where NPV becomes 0, sensitivity by that method. That is, if the discount rate increases by 60%, the NPV will become 0. So when the discount rate becomes 16%, the NPV becomes 0, right? It's 0 in IRR. So 16% is that rate. So what would our discounting rate have been? Assume it to be X. 16% minus X divided by X into 100 is the sensitivity formula, factor change. That is 60%. So you will get the discounting rate X equals to 10%. A very good reverse calculation question. This is one of the chapter's best questions. Then using this rate, cash inflow will PV the initial investment which gives the NPV. You got this. Now look, the third case is even more special in this question. If you look at the third case now. Now look. Third. The question now asks for the annual fixed cost of the company. Its sensitivity for this purpose is given such that the NPV is becoming 0 is this much. That is, if the annual fixed cost will change by 7.8416%, it will increase by 7.8416%. Then your NPV will become 0. So that is, if you do change in fixed cost divided by existing fixed cost into 100, you will get 7.8416%. This is given. You have to find the existing fixed cost, and to calculate this, you must determine the amount of change in the fixed cost. How will you proceed? NPV is 29,727.50. This is what you have to make 0. How can this be made 0? By increasing the fixed cost if we increase it for 5 years in the future. By how much? By this amount. My NPV is 0, but that will increase in the future. NPV is of time 0, so future fixed cost, I will increase it by X amount. And if I do its PV, it should be equal to 29727.50. That's it. So I have to change the fixed cost by X annually. PV equals 29,727.50 to 0 NPV through fixed cost. The fixed cost change is found. You have the fixed cost change amount and knowing the percentage, you find the existing fixed cost. It's calculated. It came out to 1 lakh. Next, observe the more special point, as this question continues to present unique aspects. Let's see further. Next, calculate estimated sales units. Tell me the sales units. For this, you will have to use the marginal costing thing that I told you about. The profit volume or PV ratio is 70% and its formula is contribution by sales. It has another ratio, variable cost ratio, variable cost by sales. So if you subtracting the PV ratio from 100% yields the variable cost ratio, as contribution is sales minus variable cost. Did you understand? The variable cost ratio is 30%. Variable cost ratio and cost are given. Multiply variable cost by sales by 100. With the given variable cost ratio, you can calculate sales per unit and selling price per unit. The selling price per unit is now in front of you. Now look, now you have to think a little. With unit selling price calculated, find total sales value. From the selling price per unit, we obtain the estimated annual sales units, which is sales volume. I will get the sales volume. How do I calculate the sales volume, as I need the total annual sales amount? How can you calculate the total amount? For that you have to understand how to do the working. You have to calculate total amount of sales. Look here. Now to calculate the total sales amount here, then look once. Your format. Let me revise the intermarginal costing one for you. So you deduct variable cost from sales to get contribution. If you deduct fixed cost from this, you get your profit. You get your profit. This is how the working is done. So now if you notice carefully here, when you deduct fixed cost from contribution, you get your profit. So what will contribution be equal to? Contribution means profit plus fixed cost. Profit plus fixed cost. And here we will assume that cash inflow is profit. So we know the cash inflow. And I know the fixed cost, then the contribution is 157,500. Amount of contribution is known. PV ratio is given in the question. So contribution by sales, put in contribution, put in PV ratio, you will get sales value. Sales value and selling price per unit are obtained. For sales volume, this is a critical question. You must revise it 5 to 6 times. After this, finally, break-even units. What were they? The number of units that result in zero profit. A number of units at which profit is zero. How will the profit be zero? If fixed cost matches the contribution, then the profit will be zero. This means we have to make contribution equal to fixed cost. Contribution must be equal to fixed cost, which is 1 lakh of contribution. So look at the contribution per unit. 200 rupees selling price, 60 rupees variable cost and 140 rupees contribution per unit. I need total contribution of 1 lakh. 1 lakh divided by 140 per unit. That is, what should be my number of units? 714.285. Break-even units relate to this contribution. These break-even units are found. So question is quite good. I have told you little bit about it, revised it for you. Then see, in your statistical technique, NPV with probability is given. Now see, identify the case. NPV with probability is very easy. After this, if you will see. For this case with cash flow probability, nothing is written and it is clearly perfectly independent. We assume this when no specifics are provided. Perfectly independent. Understand perfectly independent from the question. Either it will be written, otherwise see it's given in question. This and this probability can be there. In first year this and this cash flow, in second this and this can be. There nothing is said for the third. It signifies perfect independence and therefore you should not make any assumptions. Okay, normally you don't consider perfectly independent in a silent situation. There is no other scenario. After this, look. Now, perfectly dependent means you will see worst, most likely and best case scenarios. Therefore, after this, let us observe here. The question provides that annual cash inflow can be of various amounts. The given probabilities allow any to happen annually. Any of these can happen annually unspecified. Whether cash flow is perfectly dependent or independent is not mentioned. Assume perfect independence and probable NPV is expected because you have studied. What does probable mean? What can it be? That is expected. You should know the English words, right? Then calculate expected NPV assuming perfectly independent. This special question, second case, asks for worst and best case NPV. This became a perfectly dependent question. Now what you do, this 20,001 has become the worst case and 40,001 is the best. For 20,000 annual cash flow, or when it is the best case, calculate the NPV. Tell me the probability of the worst case if the cash flow is perfectly dependent. The worst case NPV is this. Calculate it as 0.1 into 1 into 1. Joint probability doesn't work in the normal way. I told you earlier. Similarly, the next question won't be clear if you approach it normally. For the first part, expected NPV implies perfectly independent. However, best and worst cases require assuming perfectly dependent for the second part. Probability of the worst case, whether dependent or independent. If dependent, this is your probability. Okay, and if it's independent, then this probability will be multiplied by the respective year 5 times. The life is 5 years. Because joint probability calculation is like this only. And in the independent cases, any cash flow can occur in any given year. It is then multiplied 5 times. Perfectly dependent, it's directly this. Then standard deviation and coefficient of variation were asked, assuming the 3 cash flow streams represented by each table column. These are 3 distinct streams, namely the worst, the best and most likely outcomes. You calculate standard deviation and coefficient of variation assuming perfect dependency. Different scenario is given in last case. And in that case, the discounting rate was changed. Now should the project be accepted? Nothing is said. Back to normal question. Assume same perfectly independent. I have explained this long question to you. Next, for this question, the first year's cash flow has given probabilities. Second year cash flow depends on the first year. And if the second year's cash flow depends on the first year's, it is moderately dependent. You'll easily understand this question. This decision tree analysis is very simple question. It does not require any complex thought. Replacement decision is very easy. I have explained the replacement decision to you. Nothing is special. You just need to apply those steps. Okay, there is no special point. In this one, look, increase in sales and saving in operation cost. All this data is given. The data for increase in sales and saving in operation cost is given in this question. Method 1 applies to incremental cash flow. And in this question, look, you have expected after-tax profit from the old machine. And for the new and upgraded machines, you will consider replacement decisions twice, once for each. For the upgraded asset, you will not receive salvage value since it is being modified, not replaced. This is not two separate decision points. The profits are provided, so use that directly. For incremental cash flow, use the second method. Remember, after tax profits are given, means no PAT is given. You will have to add back depreciation in these. Since the old machine's book value is 0, it does not incur any depreciation, meaning if we continue running it, these will represent its cash flows. For the upgraded machine, you calculate each year's depreciation and then add it. And for the new machine, check each year's depreciation and add it in this. I'll show you in question because we need the cash flow. And what is given to you? No PAT. I'm showing you this in case of new machine. In case of new machine, you found the depreciation on the new machine to be this much. For the new machine, the given no PAT has depreciation added. Then by taking that difference, we get incremental cash inflows. Then you calculate its PV, incremental NPV, and it's simple. A very easy question. After this, these were the useless when to replace questions. As I had explained, useless question. Lecture of asset using equivalent annual cost. The same simple one. Optimum replacement cycle is easy. Now look, there is tax. Then the asset's initial investment and annual operating costs are provided and its resale value is given for selling in year 1 or year 2. So if you run it for 1 year, then in that case, for 2 years, calculate the EAC. And for 3 years, it's EAC, wherever it is best. Lowest EAC will take that as optimum replacement cycle. All these 3 questions are exactly the same. It was explained in class. These were simple question of real options, like the PV of the cash inflows and all. At 0 time, this represents your initial investment and it is your timing option. Invest today or after 1 year. If you do it today, then you will do PV of cash inflow. There will be benefit of 21 lakhs every year. This is same example. After 1 year, government changed, electricity rates will change. Every year there will be benefit of 12 or 35 lakhs. Calculate cash inflow, PV for upper and lower sides and WACC, the cost of capital, serves as the discounting rate. We have calculated, understood. Binomial model uses risk-free rate for risk-neutral probability 1 plus RT. You will calculate that. You will get probability of binomial model. The payoff in both the upper and lower cases is obtained. The PV of the expected value will be the value. After this, we will now look at your abandonment option. For the abandonment option, look, the proposal's present value is this. After this, if the market conditions are favorable after 1 year, PV increases 30%. If it reduces, it can fall by 40%. So if I show you the solution, $100 after 1 year, you can see it can change by plus 30% or it can fall by minus 40%. So make a decision tree. 130, 60 and 100 is visible here. What will be the payoff? And the disposal value of it is 80 crores after 1 year. 8% risk-free rate, value of abandonment option. If it is 130 crores, why 60? If it falls to 60 crores, you sell for 80, gaining 20. Calculate the risk-neutral probabilities. You have calculated payoff and abandonment option. Let's check the last growth option. It's same in growth option. We are manufacturing. The medicines, this same company operates with similar data and it holds a medicine patent that has a 15-year life. Investing in this project now for medicine development incurs this cost, which will be strike price. Then present value of cash inflows. This is your current underlying price. Variances are given to you. The current yield and the treasury bond rate are both given to you as the risk-free rate. The remaining data is provided and Black-Scholes model questions appear in exams. So there's nothing in it. All the data is given, time and everything. You will calculate D by 1/15th and then simply put the data in the formula. You will get the answer and there's nothing special in it. With this, I have now explained the entire chapter to you. I have covered all the concepts and I have even revised the essential and special points from the question section for your benefit. So there shouldn't be any problem with that either, even for the outside students. Okay, I have explained you the questions in this chapter because you get a better idea from the questions. There should be no problem now. Please solve the questions yourself once. For outsiders, match your answers. Class students have practiced everything. Always note it down as this will be useful for revision. You will never be able to refer directly to the solution. You won't understand what's happening. The solution is the same, but they write things up and down, they disappear some things in between, and final result is written. You won't grasp its source. So my solutions are completely stepwise according to the institute. But yes, this is in a very proper structured way. You are going to get all the marks in this. You have to present it in this way. Writing it in the normal language, all that doesn't matter at all. Present it as I have shown. Lining and all don't matter, only the amount has marks. So revise it. If you have any doubts, then ask. That's all for today's class. And if you like the lecture, if you find it good, then you should like it on YouTube. If you like the lecture, show appreciation in comments and share any doubts there. And if you want, you can also recommend it to your juniors if you like it. That's all for today. Thank you so much. Hare Krishna.